Good morning. Good morning, and thank you all for joining us. My name is Bart Rowland, and I'm State Representative from Kentucky and Chair of the NCOIL Property and Casualty Committee. I'm going to moderate this general session this morning. We have a great panel of speakers with us here today to discuss a very important and timely issue, the current landscape of cyber insurance and the challenges of ransomware and beyond. Ever since the news regarding the ransomware cyber attack that hit the Colonial Pipeline a few months ago, news headlines have been flooded with stories about the growing threat of cyber attacks, ransomware, and what cyber insurance can do to help protect them against them. The growing risk of cyber attacks makes cyber insurance protection more important than ever, while at the same time creating new challenges for insurers managing that risk. Problems have recently been associated with the cyber insurance marketplace, such as both higher prices and lower coverage limits, and of course, the debate about reimbursing for ransom payments. Just recently, the major cyber insurer AXA decided to stop reimbursing for ransom with all new policies in France. At the same time, APCIA recently publicly defended ransom payment reimbursements by insurers in a new set of principles, stressing that the insurance industry wants to partner with government and business to improve cyber security. In light of these developments, the panel we have here today was developed to help inform us on what we as public policymakers need to know, what we should or should not consider doing as we bring these issues back to our states for further discussion. So joining us today are John Pendleton and Winnie Sin, Director and Assistant Director of Financial Markets and Community Investment at the U.S. Government Accountability Office. Matthew McCabe, here in person, Senior Client Advisor at Marsh. Peter Halfren, Partner at PASIC LLP, and Dr. Josephine Wolf, Assistant Professor of Cybersecurity Policy at the Fletcher School of Tufts University. And I don't want to take up any more time from our speakers and the Q&A session. So I urge you all to reach out, read their bios, which are in the conference program and on the app, and to reach out to them afterwards to learn more about them and about these important issues. So our first presenter this morning will be via Zoom, and that will be John Pendleton and Winnie Sin. So thank you for being with us, and you may proceed.
Thank you very much. Can you hear me okay? Let me do a quick sound check.
Yes, we can.
Thank you so much for having us. My name is John Pendleton. I'm a director in the financial markets team, and Winnie Sin's my assistant director, and she led this work. And we appreciate the opportunity to be here. I have to start by telling the chair that I'm from Kentucky, from Adair County, Kentucky. If you ever heard of that place, I grew up there, went to the University of Kentucky, and started my GAO career in 1987. So I have been here pretty much my whole professional life. But it's nice to hear a friendly accent there, Bart. So I'll be presenting the work of our team today and talking about just some of the high points to make it fast. I don't know who's running the slides, but you could go ahead and bump one. If you're not back up one, please. If you're not familiar with GAO reports, this is the way they look, the cover page. And then we normally have a single page highlights that we've reproduced here. The number in the bottom left corner, GAO 21477, is what you need to know to get the report off our internet site. But I want to talk just a little bit about the origins of GAO and our role in all of this. We were created in 1921. That's the reason if you saw my background, it had the GAO at 100. We are 100 years old almost to the day here based on the legislation that passed. We were created as a balance of powers effort when they created the Bureau of Budget, now Office of Management and Budget. And GAO over that 100 years evolved from sort of voucher auditors with the green eye shade things to what we are today, which is sort of a full range professional services organization. Winnie and I are analysts in one of our core teams. We do some insurance work at GAO, not a ton. The federal nexus here is a little tricky because it's primarily state regulated, as all of you know. The way we got pulled into this, and if you could give me the next slide, that'd be great, was the National Defense Authorization Act. That is the House Armed Services Committee and Senate Armed Services Committee put a provision in that asked us to study the availability of cyber security insurance coverage. It came pretty much directly out of a recommendation, the Cyberspace Solarium Commission, if you're familiar with that. They had recommended that GAO do some work on this. And so they put a very quick 180-day mandate in for us to do this. So this was a quick little report for us. Typically we take a bit longer, go a little deeper. And we spun this out of some ongoing work we have on cyber terrorism insurance work, kind of seeing if there are parallels to the TRIA program and other things that came out in the Appropriations Act last year. So this is at this point a body of work. We did not time this report in May to come out as the Colonial Pipeline hack was making the news, but it did. And so this what we consider to be a fairly tight little report with a few statistics in it got a great deal of interest. And again, we're proud to be here to talk to you about it today, but it is part of a body of work. If you could go to the next slide, so please. I heard that someone from Marsh is here. We stole some of your data, I think with your permission, but to talk about take-up rates for your clients. And you can see that it nearly doubled from 2016 to 2020. And so we read that as increasing demand and the fact that more insurers were starting to get in the market, although most of the policies were written by a few big companies and folks were able to afford it and buy it. But we don't know exactly where this is, even as we wrote this report earlier this year before all the hacks and all the upset in the industry. Next slide, please. Thank you. These data are the best we could do, but we thought the trend was very interesting, and that you see insurance premiums pretty flat until the latter part of 2019, and then a pretty steep upward curve in 2020. And I can't imagine that this is not continuing, although we haven't updated the data. We're following it as part of the other work, but so you started to see insurance premiums going up in 2020. If you would go to the next slide, please. And then we saw a tightening market last year, reduced coverage limits for certain sectors. Insurers were tightening up, more exclusions, and then starting to write more cyber specific policies. I think the market is still a long way from shaking out. So next slide, please. I think Winnie can take it from here and talk about some of the challenges we saw, again, when we wrote this report in February and March of this year. Please, Winnie.
Sure. So the second part of our report looks at challenges facing the cyber insurance market, and we go through a number of them in the report, but I'll just highlight a few here. The first is limited historical data on cyber losses and events. So what we found in our work is that historical data on cyber losses can be very limited, incomplete, or of poor quality. And as we know, that can make it difficult for insurers to develop reliable actuarial models and properly price policies or set appropriate coverage limits. And then with that uncertainty, it could lead to higher prices, as we'd already been seeing, or tighter limits on cyber policies as insurers try to mitigate against that uncertainty. There have been some efforts to address this challenge. So the Cyberspace Solarium Commission that John mentioned has proposed that Congress establish an entity that's specifically charged with collecting and sharing data, in part to help insurers create better risk models. And then the Department of Homeland Security, their working group on cyber incident data analysis, has also had discussions about creating a repository of anonymized data that would voluntarily be submitted by insurers. And then the second challenge I'll touch on is the lack of common definitions. So unlike some other lines of property and casualty insurance, which might be more standardized and you have more consistent definitions across policies and insurers, there's less consistency across cyber policies. And what we found was that language used in cyber policies varies greatly and might not have terminology, might not have consistent or clear definitions, especially for larger policies, those with $5 million in coverage or more. So for example, some of the terms that might not have clear definitions include things like cyber attack, cyber war, cyber terrorism. And then as another example, we also heard that insurers might have different definitions for what constitutes a ransomware attack. So these sort of uncertainties and unclarities can be problematic for both insurers and policyholders in the aftermath of an attack where it's not clear what is covered and what isn't, and can result in lengthy delays on paying claims, but also potentially just lengthy litigation. So there have been some calls, including by the Geneva Association, for more common terminology in cyber insurance to help with policyholder understanding and just to help policyholders make more informed decisions about the policies that they're purchasing. And others have recommended a set of uniform definitions for key cyber insurance terms. And then the last challenge here is just questions about the applicability of TRIA, the Terrorism Risk Insurance Act. So as I'm sure you all know, TRIA provides a federal backstop for private insurers in the case of a certified terrorist attack. And Treasury has stated that a cyber attack could invoke TRIA if the attack met all of the requirements for being certified as terrorism. However, even though kind of in concept or in theory, a cyber attack could trigger TRIA, there's some question about whether the likelihood of that happening in practice. And in particular, Treasury's definition of terrorism might not be particularly suited for cyber attacks. So for example, Treasury states that to be terrorism, an act must be violent, dangerous to human life, or motivated by coercion of the US government or US people. And cyber attacks are often conducted with financial gain in mind rather than coercion. They might not be violent or cause damage to human life or property, although with some of the recent attacks on critical infrastructure, it's not too hard to imagine that that could become the case. But still, there's this uncertainty over whether a cyber attack, the likelihood of a cyber attack triggering TRIA, even a very large attack or a systemic or catastrophic one, leaves some uncertainty over the extent to which TRIA in practice provides a backstop for these kinds of losses. There have been some suggestions that Congress expand TRIA to more explicitly include cyber, or even create a separate kind of cyber TRIA that's more tailored to cyber attacks. But these are some options and questions that, as John said, we're looking more into in kind of our ongoing body of work on this topic. John, do you have anything else to add?
Oh, just thank you, Winnie. That was excellent. And that's it. I think we can take questions or move along to the next speaker. It's up to the chair.
Thank you, John. Thank you, Wendy. We'll move on to the next speaker and we'll hold the questions till after all the presentations have been made. So at this time, our next presenter will be Matthew McCabe, Senior Client Advisor at Marsh.
So thank you all for the opportunity to present today. I was told that this was on Saturday morning, and would that be a problem? I will tell you that at one point I spoke at an oil and gas conference, and they actually slotted me against the Friday night happy hour. So this was really no problem to come up and make it. So you're going to find a lot of my comments have some overlap with the GAO, and it was Marsh's pleasure and privilege to work with the GAO. But yeah, there was a lot of our data which fed that, which is a very stark realization of what's going on in the cyber market. So this first slide is just an overview to start with for cyber insurance in case anybody doesn't really know this product. Cyber insurance is a very specific product that was created out of exclusions that were thrown on other policies. So if I were in an elevator and had to tell you what it was really quickly, it's three things. You've had a cyber incident and you have to pay for costs out of your pocket. You're restoring data, you're paying for lawyers to investigate, you're paying for forensic companies, maybe you're responding to data breach costs. Number two, you've had a cyber incident and somebody sued you for it and you're paying the legal fees and potentially damages resulting from that incident. And number three, you've had a cyber incident and your business operations are down and you don't have income and you're perhaps bleeding money on extra expenses just to keep your business going. That's basically what cyber insurance covers. Obviously, as touched on by the GAO, ransomware has kind of turned the entire industry sideways. And two or maybe three costs that have really become relevant are number one, the extortion demand payment, number two, business income loss, and number three, the data restoration of actually restoring your systems to try and avoid paying that demand. There was the touch on by cyber terrorism. Know that a cyber event can have a physical outcome, and that can be a property loss, and that could be a very, very real terrorism incident. I think the number one cap on cyber terrorism right now is most terrorist organizations don't really have the capability to make these broad cyber attacks. But as the GAO touched on, most cyber attacks are financially motivated. So, this largely reflects what the GAO covered, but this is our industry right now. You can see that claims are increasing in frequency and severity. I know we have a speaker from DFS. They put out a survey report in 2020 that had some real eye-popping stats on where ransomware has gone. I believe it was 180% up year over year in frequency and 150% in severity. And that perfectly matches up with GAO's stat of when we started to see these ransomware uptick, of when premiums started to escalate. And that's had the impact. The GAO touched on pricing. I will say that when the GAO report was released, we did have conversations with our carriers. Maybe I should just clarify that a bit. So I'm with Marsh, and anybody who doesn't know, Marsh is the largest insurance broker in the world, and we represent clients in going out and buying insurance from carriers. So some of the carriers would come back to us and say, it was kind of a tough report on our industry. And, our response was, look, facts are facts. It's not a good time. It's a hard market. And it's because a lot of claims are getting paid out by the carriers. And those are tough claims. Those are claims for ransomware incidents that as soon as they happen, there's probably a payment out the door within a month, right? That's a payment that was not reserved for, that is just straight off your profit line. So they've, some of the top demands have reached over $40 million. That is not typical. That definitely pulls up the average. But there have been some mighty whale ransomware attacks that have had those kind of incidents. I know that Colonial Pipeline was cited earlier. That was just about a $3 million payment, but of course grabbed some headlines because of its effect on infrastructure. So that has caused rates to escalate. At the end of Q1, we were at an average of 40% increase per client. That means that some clients got 20%. There were some clients that got a year over year 100%. I can tell you, I had a client who renewed, they had a 200% increase in their premium. The reason being, they were an industrial control company, and when their insurance was originally placed, the carrier looked at them and said, you have no personal data, you have this remote risk of loss, and we're going to sell you something at dirt cheap premiums. Come around in just a year's time, they're looking at them and say, you have all sorts of exposure in your system to a ransomware attack, and there's no way we can price a $3 billion risk at the premium we charged last year. We went into the market, we went to more than 30 carriers to try and compete that increase, and no carrier would price any lower. So they renewed with their incumbent, and they did so very angrily, I can tell you. And then for underwriting, it was touched on that, I don't see coverage shrinking. What I see is limitations. So coverage is still available for ransomware and loss from ransomware, but a carrier might make only $5 million available where they previously made $10 or $15 million available. In addition, we're getting terms like, okay, the Microsoft Exchange server vulnerability is well known, so we're going to exclude any loss that comes from an exploitation of that vulnerability because you should have mitigated it by now. And we're starting to get kind of an entire index because these events, these catastrophic events, Kaseya from the event before, potentially 1,500 affected companies by that vulnerability. Well, it's just one event after another, and now we're having a list of exclusions for specifically known events that are getting tagged on the end of every policy, eventually there's a potential that those exclusions are going to be longer than the actual length of the policy. So, this is a little in the weeds and for technical stuff, but these are kind of subjects that are the subject of underwriting for clients now. And if you're not matching up on these controls, then your placement of a cyber insurance policy is in jeopardy. You might have most, if not all, carriers who will simply walk away from you and say, I can't insure you. Some of the very important parts are endpoint detection and response, multi-factor authentication to control access to your systems, and segregation of your backup data to your primary data, so that if you have a ransomware event and you lose all your primary data, you better not lose your backup data in the same incident. It has happened that there were clients who were affected by that problem, and they simply have no option but to pay a ransomware. So, I put these up there as just kind of a very simple list, but it's really coming down to that concrete, like if you don't have it, you could become uninsurable. And this, Marsh recently put out what was a guide for ransomware on how to deal with it. I did not kind of go into the specific bullet points, but having reviewed it and having participated in the construct of the guide, I would put it this way. First of all, let me ask a little trivia. Does anybody recognize the quote? I'm sure we have some ex-military in here who probably know it. So, plans are nothing, planning is everything. That comes from Eisenhower. And basically it means that you can write up your incident response plan and you can think that you might know what you're going to do at the time of the event, but it's really going to change in the dynamic situation that you have. So the important part is to go through incident response planning and to test it. And what the Marsh guide does is say, here are your options and here's what you're going to have to know about ransomware. You're going to have to assess what your assets that drive your institution, what those core assets are. You're going to have to make sure they're replicated and that they're stored offline, whether it's in the cloud, whether it's in tapes. Then you're going to have to make a real assessment of how long you could get back online using that data. Then when it comes to the event, you kind of have the spider tree of 3 decisions. You can pay it, you can try and break encryption, which is probably never going to happen, or you can go to backup data. Probably your preferable option, but unfortunately one that is not always available. I can tell you that there's decisions being made out there for the pipeline breach that was previously referenced, that they had backup data and they were able to restore their pipeline operation. It was not actually the pipeline that was affected. It was their own IT, but for safety purposes, the pipeline was shut down. So the decision that was made was pay the ransomware and get the decryption tool so that we can come up faster. And then when they got the decryption tool, it was realized that the decryption tool works very slowly, so that they were actually able to restore their data and they never actually had to pay that demand, but they didn't know that until they'd actually gotten the tool and found out it was kind of a bulky, useless tool. So know what your options are. Make sure that you have senior sign off on what you do. And then, kind of as Eisenhower told us in the era of World War II, always go through the cycle of assessment, testing, learning, and getting back to it. And that's one thing that if I'm here to represent the insurance industry, I think that insurance has become a key partner to regulators and to those who have interest in bolstering systems. Because if we go back to that list of the ransomware controls that are more sought after, you'll see, I reference a framework developed by NIST, and there's a lot of commonality between what that list is and what NIST is publishing as recommended guidelines. And that's not a coincidence. The insurance industry looks to government to know what the best practices are. And then they align them with their claims. And then when they see the most highly relevant one, we are actually the touch point of every renewal, and even mid-cycle as we're gearing companies up for renewal, of saying, are you doing these practices? And if you're not, there's going to be financial consequences to it. So I think cyber insurance, although it is going through a hard market and a difficult time, has kind of developed into an ecosystem of real assessment that's being bolstered by government regulators and being carried out by markets on an incentive-based program.
Thank you. Our next presenter will be Peter Halfren, and he is participating via Zoom. Peter, when you're ready.
Yes, and just want to make sure, can everybody hear me?
Yes, we can.
Some thumbs up and some nods. Well, thank you all. I'm sorry that I can't join you in Boston. Good morning, everyone. Before I get into the substance, I'd like to thank the National Council of Insurance Legislatures, General Counsel William Malofchik, and our moderator, Representative Rowland, for having me here today. I'd also like to thank this distinguished group of panelists, Mr. McCabe, Director Pendleton, Assistant Director Sen, and Dr. Wolf. I'm honored to be a part of this group and to speak on the subject, excuse me, of ransomware insurance coverage. I think it's an extremely important topic, and I'm pleased to share the experiences of my clients, policyholders who have been impacted by the scourge of ransomware. To briefly introduce, my name is Peter Halpern, and I'm a partner in the New York office of Passage LP. I represent commercial policyholders in insurance disputes. This is something I've done my entire career, but now it seems to increasingly focus on insurance recovery in relation to cyber breaches and cyber crime. Before talking about ransomware and the future of the cyber insurance market, I just want to set the scene a bit and talk about policyholders and how they've been affected by the scourge of cybercrime over the course of my career. I would say probably starting around 2015, we started to see an uptick in business email compromise insurance claims. At first, it was just a trickle here and there, and then it started to become a regular part of the practice where we were frequently getting notes of these claims. And then around 2018, the Second Circuit issued a decision in metadata versus federal insurance on coverage for business email compromise schemes under crime policies. In full disclosure, I worked on an amicus on behalf of a nonprofit there. And I think that was really the time where it reached a peak. After that, I think the insurance industry moved to change some of the language associated with crime insurance policies. And so those claims became less frequent. But I would then say the fact patterns in the cases also started to evolve. At first, the schemes that we saw were fairly straightforward. There was a phishing attack on a company or maybe a spear phishing attack on an important individual, and it led to companies being defrauded out of millions of dollars. The loss of this money hurt these companies, but I would also caution and keep in mind that there's a human toll here. People were fired or embarrassed, IT professionals lost their jobs, and ultimately there was a loss of trust, both in using the internet to conduct business, as well as in people that you work with who you thought were sending you emails, and also the IT professionals in your company. There was a real loss to a company, and I think that's important for regulators to keep in mind. The criminal enterprises grew in sophistication over time, and they began to undertake new schemes that we saw, like invoice manipulation. For those that don't know, in those schemes, the vendors would send quote unquote real invoices, which would have payment information that was typical, except that it would be modified. So instead of sending your payments to a bank in Kentucky, all of a sudden now the payments were being routed to a bank in Hong Kong or in Mexico, or maybe not, maybe in California. But either way, there was a change in payment information, and all of a sudden the company started paying money to the accounts of what they thought were their vendors, but were actually fraudsters. Now, luckily, after a few months of unpaid invoices, most companies would be jumping up and down saying, hey, it's been 90 days, it's been 60 days, where's my money? And in most cases, the schemes would then be discovered. And within a short period of time, companies were able to figure out what happened. And in some cases, my clients were able to work with law enforcement to actually track down some of those payments and to recover some of their monies. And the sophistication of the schemes continued to increase beyond that. We started seeing schemes where, in addition to what I mentioned before, the threat actors were starting to use the phone. They were using phone calls. They were coming up with ways to get around verification defenses and other things that companies had put in their way to try to avoid these schemes. And they would fool even the most diligent of employees. We also started to see an uptick in what they call man-in-the-middle attacks, wherein the threat actors would essentially toy with both sides. And by the way, all my hand motions look really odd on Zoom. I can assure you that if we were in person, it would look much better to see my hands flailing as they do. But I'm a New Yorker, so I can only speak with my hands. My mouth is just backing them up. So we had these man-in-the-middle schemes, and so what would happen is the threat actors would insert themselves in between both sides of the transaction. On the one hand, they would tell one party, hey, all your business information, email has changed, please send the payments to this place. But then on the other side, they would also play an active role in telling the other side of the transaction, oh yeah, the payments, it's coming, what you expect is coming, it's coming, we're just having a glitch here. And through that, they would continue these schemes on and on and on. And I found these schemes to be particularly nefarious. And oftentimes as a lawyer dealing with these things, we read the emails and we see the forensics reports after the fact, and you see the back and forth. And these criminal masterminds are really playing both sides in a truly nefarious way. There's a lot of planning and manipulation there. But somewhere around 2019, and I'm fast forwarding to the future, you tell a lawyer to talk, obviously it's always a perilous situation that could continue indefinitely, but I know there are time limits here. I started to receive calls from clients who were the victims of ransomware attacks. Now, I think the impacts of these attacks are significant and long lasting. At the outset, a business can't access their files, and that's really challenging. We have clients in the healthcare space, for example, that couldn't access patient appointment times and dates, patient health records, employee schedules, employee time and payroll records. And this had real consequences. This meant that people who had chemotherapy treatments had to miss their appointments. Recently, in addition to locking the door to computer access and systems access and holding the key for ransom, we're also starting to see actors exfiltrating data and publishing it online. There was a recent report that some of these actors were actually using that information or using the threat of sharing that information to suggest that people might be able to gain advantage in financial markets by trading on insider things that they could bring to bear, which I think is a particularly terrifying development. But again, going back to the ransomware attack, you have a business that can't access their files. They're losing out on sales. They're losing out on appointments, as I mentioned. They're losing out on opportunities, and ultimately they're losing out on income. Now, in addition, you have employees across the business who then have to respond. They try to put together workarounds. They try to recreate systems and processes. They're working late. They're sleeping at the company, trying to figure out ways to keep the business going. You have executives who can no longer focus on the thing that they were trying to focus on, running their business. Now they have to work on recovery processes and finding outside resources. And those resources, which I think are most important in a pinch, forensic, legal, ransom, and insurance that can aid them in recovering from the attack and avoiding further losses. Now, in some case, insurance coverage or insurance resources, such as those provided by cyber coverages, can be brought to bear. And those resources will include the forensic assistance, they'll include the legal assistance, maybe privacy counsel, and also ransomware negotiators and those kinds of resources. And so for those companies that are facing these challenges, the help is welcome. But the challenges or the recovery is challenging. And oftentimes the limits of these insurance policies are insufficient to cover the losses associated with a ransom attack. And that's frequently what I'm seeing, where the limits just won't do justice to the damage that's been suffered. And so, and I believe it to be my purpose on this stage or this screen, is to remind you, those who regulate and legislate these issues, to remember that the victims of these crimes are victims and that they truly have suffered as a result of these attacks. It's not merely statistics, these are real people. And I will give you an anecdote that I've heard, was not my client, but apparently there was a dental practice in the Midwest, two older gentlemen, they got hit with a ransomware attack and they just decided to close the practice. We're not dealing with this, we can't deal with it, we can't figure out all this stuff, it's just too much for us, we don't know where to turn, and they just shut down their practice. And that impacts the community, and that has a real effect. So I think it's important to continue to keep in mind that these businesses have people and customers and all that as part of the ecosystem. So because of this, I think cyber insurance can play a vital role, both in providing the resources to deal with an incident once it arises, and to help protect the bottom lines of companies by providing them with some level of indemnification for their losses. Now, disputes are unfortunately starting to arise. And many policyholders dealing with the fallout of a ransomware incident are now also finding themselves managing an insurance coverage dispute. I think Assistant Director Sen gave some remarks to this effect earlier, and which I'll come back to. Now, for the most part, the disputes my clients are having with their insurers are less about the insurance coverage terminology and more about the quantum of loss. So in other words, the insurers are retaining accountants who unsurprisingly given their role, are finding that the insured losses are far less than those estimated by the insured. And so the arena, at least in this space, has shifted to the world of numbers. And so the accountants on both sides, as in the property insurance realm, are fighting to try to find some agreement as to the measure of the insured losses. There are also insurance coverage disputes brewing, and I'll come back to that. But for the most part, what I am seeing, and the reason that I'm being called upon in the first place, is because we're seeing issues about valuation and how to handle and how to measure a loss. Now, some of the prior speakers and their employers have worked on various guidance documents and reports which illustrate the problem of ransomware and the associated insurance market challenges, I think on a macro level. And again, my hope is to bring us down to the micro level as well. The GAO report, which Director Pendleton and Director Sen reviewed, begins by saying that malicious cyber activity poses a threat to the federal government and the nation's businesses and critical infrastructure, and it costs the U.S. billions of dollars a year. Among other observations, and they've traveled it well, so there's no point in me going through all of it. I think it's important that they note the increasing prices for cyber insurance and the decrease in coverage limits. They mentioned Marsh, and we had Mr. McCabe here talking about Marsh and Marsh's observations. And I will tell you that those observations are shared with other brokers as well. Insurers want policyholders to pay more for less. In February of 2021, DFS launched their cyber insurance risk framework, which noted that cybercrime was becoming more common and more costly, and that the risk was increasing for all organizations. As part of that framework, they recommended against making ransomware payments, and those conclusions were rooted in those of the Department of the Treasury's Office of Foreign Asset Control's October 2020 guidance. A few weeks ago, on June 30th, DFS issued a further ransomware guidance, noting again that it recommends against paying ransoms, and further noting that ransomware attacks can be prevented. What I think is particularly helpful about that DFS report is the suggested controls that companies undertake. The controls include email filtering, anti-phishing training, vulnerability and path management, multi-factor authentication, password management, and the preparation of incident response plans. And I think Mr. McCabe covered this well in describing some of the things that insurers are looking to and some of the things that are part of the underwriting process, which include those items. So I do think there's another place where insurance can play and does play a productive role in bringing companies up to a certain standard by saying that otherwise a risk is essentially uninsurable. I would also note that Professor Wolf wrote an excellent piece in the Washington Post on 5 myths about ransomware, which does talk a bit about the limitations of multi-factor authentication, although I think we can all acknowledge that there is benefit there to having that in place. So I applaud these suggestions, and I hope that companies large and small undertake them. As I've advised clients, my biggest takeaways from the regulatory efforts of the Department of Financial Services and the SEC, as well as what we're starting to see now, which are follow-on lawsuits against corporations after cyber incidents, mostly securities class actions, is that the ostrich approach will not work. It is incumbent upon businesses to be proactive and to take basic measures to protect their cybersecurity. This means testing for vulnerabilities and then acting to patch up those vulnerabilities before they can be exploited. I say test, test, and test again. I think testing and planning for these incidents is critical, but also taking care of known vulnerabilities that arise from such testing. And again, if you look at the DFS enforcement actions to date, and also the follow-on SEC action against First American Insurance Company, a lot of that was focused on the fact that the testing revealed vulnerabilities, and then the company failed to act to address those vulnerabilities. And as a result, you also saw a class action lawsuit. So these things are becoming very, very expensive. For the insurance market, I think playing a productive role in this ecosystem means continuing to evolve in a manner whereby proper underwriting and diligence is undertaken before selling cyber coverages. I say cyber coverages, and I've said that throughout, as opposed to cyber insurance, because I do think it's important for all of you to note and to be aware that there are numerous insurance policies which may offer coverage for cybercrime and for ransomware. In fact, earlier this year, the Indiana Supreme Court, in a case called NCOIL, ruled that a policyholder could be entitled to coverage for a ransomware payment under crime insurance. Likewise, last year in 2020, although I know for all of us, years feel like decades these days, but last year, 2020, in the case called National Inc., the Federal District Court for the District of Maryland found that a policyholder was entitled to recover the damages to its data and systems associated with a ransomware attack under I believe it was under a property policy. So following recent ransomware attacks, I've advised clients in connection with recoveries under crime, cyber, D&O, directors and officers insurance, EPLI, employment liability insurance with regard to employee records that were placed online, and general liability, among others, all of which had pertinent coverages. But I do think that the evolution of cyber coverages also requires that insurers be honest with their policyholders, honor their policy obligations, and utilize clear language in relation both to what is covered and what is excluded. And I know Assistant Director Sen and the GAO report also touch on this, so I don't want to repeat it too much, but I do think, coming from my perspective, I need to share a few things. So as I mentioned earlier, while most of my clients who are in disputes over cyber insurance issues are fighting about quantum and not coverage, I am starting to see fights about the meaning of some policy terms. And I think Assistant Director Sen pointed to some of the terms that we're starting to see fights about. I would also add that there's some fights about upgrade and what constitutes, a new system versus, obsolescence and all of that. But this issue of clarity in insurance policy drafting isn't a new one. Writing in 1970, the Supreme Court of Kentucky, home state to Director Pendleton and to Representative Rowland, in the case Universal Underwriters Insurance versus Travelers, said that most insurance policies are, quote, a virtual, impenetrable thicket of incomprehensible verbosity. It seems that insurers generally are attempting to convince the customer when selling the policy that everything is covered and convince the court when a claim is made that nothing is covered. In this regard, the litigation in relation to insurance coverage for pandemic losses, which I know this organization has dealt with, I think, at prior meetings and in general, has reopened the door to some of these conversations about clear policy language, mirroring the Supreme Court of Kentucky many years ago. A court in one of these cases recently said that the terms of the policy require the insured to fall down a rabbit hole and wander through a vast thicket of verbiage that would leave even the most careful reader mystified by the mazes of pages to be pierced together and deciphered in order to determine if there is coverage on the other side. Now, picking up on that theme, perhaps the same report mentioned by Assistant Director Sen from the Geneva Association said that, quote, there's a broad consensus that post-pandemic insurance policies need to be clear about what they do and do not cover. So to conclude, I think we all know that the challenges of cybercrime are significant and that it will take coordinated efforts to combat them. In my mind, these efforts involve a combination of one, cyber hygiene and cybersecurity efforts by businesses, and absolutely my clients have a responsibility to take action here. Two, government action to deal with the threat on a global and a national level. And I know that the Biden administration has taken a number of aggressive steps in the last few days to try to both bring agencies together and have a coordinated federal response, and also to empower people. Even the ransomware website that they set up is huge. I remember, in 2018, 2019, when I first started getting calls about this, people would say, do you have a phone number for someone in the FBI? I mean, they literally had no idea where to go. Now I do, but in early 2018 or late 2018, I probably didn't. At the state level, I think it's important for you all to do two things. Number one, make sure our schools are churning out cybersecurity professionals and to work to improve education and literacy on hygiene and these things, since I know this is something that's taken care of at the state level. And number two, to make sure that insurers are held to account if they do not abide by their promises. The third thing in my combination, which is, I promise a list of three, although of course I kept talking, is that we need a healthy, robust insurance market that provides affordable and suitable insurance to customers that is clear in what it does and does not do. So to surmise, cyber hygiene and cybersecurity efforts by businesses, government action to deal with the threat on multiple levels, and a healthy and robust cyber insurance market. I think it's only with the confluence of these actions in harmony that we can reduce the incidences of cybercrime, while when such crime occurs, muting the effects and protecting the bottom line of businesses and ultimately the national and global economy. I thank you for your time, and I thank all of my fellow speakers for their reports and for their contributions.
Thank you, Peter. Our final panelist this morning will be Dr. Josephine Wolf, and then we'll have questions and answers from the committee members. Dr. Wolf, you may.
Thank you so much. I'm so honored to be here. I'm sorry not to be there with you in person, since usually I am in the Boston area, but this week I'm on the West Coast, and therefore speaking to you from this very aesthetically pleasing hotel room background. I study cybersecurity and cybersecurity policy specifically. So I look at the questions around what incentives do organizations have to invest in different kinds of cybersecurity controls? And in particular, I focus on that by studying the aftermath of cybersecurity incidents. What happens after there's a breach, after there's a ransomware attack, after there's a denial of service attack? Who gets sued? Who has to pay for it? Sort of how do the costs shake out? And do they shake out in such a way that the stakeholders who are in a position to be able to invest in important controls actually have incentives to do that? And so I got interested in insurance, not because I have a background in insurance, but because as I was studying sort of the aftermath of these incidents and who pays, starting about 5 or 6 years ago, more and more organizations started saying, well, a big piece of this is sort of what kind of insurance do we hold? What does our insurer tell us to do? How do we, decide what's covered or what's not covered or what they advise? And so I started looking at the cyber insurance market, which has been a really fascinating source of research for me over the past 4 or 5 years. And also, I think, a really complicated thing for people in my field of cybersecurity to sort of think about whether it's a good thing, whether it's a bad thing, how it's affected cybersecurity outcomes. So I think you've heard, really wonderful remarks this morning on the ways that this looks from the insurer's side, perhaps from the policyholder side. I want to talk a little bit about what this looks like from the cybersecurity side and how people like me who care about driving down cyber risk view the role of insurers in this space. And I want to start by acknowledging a huge failing of my field before I attack insurance, which is that we don't really know what works for cybersecurity, right? We've had people like me and many much smarter people than me working on cybersecurity and how we can protect against various attacks, from ransomware to data breaches to espionage. And we have a lot of recommendations. Matthew McCabe mentioned the NIST cybersecurity framework, which the NIST folks spent many years developing, which I think is a useful tool. We have a whole bunch of NIST publications, special publication 853. We have a whole bunch of industry organizations that have come up with best practices that they recommend. We think a lot of those things are good. We think multi-factor authentication is helpful. We think maybe phishing training helps a little, though very unclear evidence around that. We think network segmentation, if it's done really well, can be helpful. But I think the Colonial Pipeline example is a good example of sort of an organization that maybe had segmented its network, but hadn't done it well enough that they were confident to be able to keep operating their pipeline after their IT systems were breached. So we have a lot of sort of ideas about what we think is helpful for security and very little good empirical data to back that up and say, here are the things we really believe you should be doing to drive down your cyber risk. And one of the things that people like me got excited about 4, 5, 6 years ago was this idea that with cyber insurance becoming a more prominent part of the response to cybersecurity incidents, there would be the potential to collect some real data based on these claims to actually say something about what works. Right, to actually be able to do a better job than just sort of waving our hands around saying, I feel like multi-factor authentication is pretty good. And the insurers themselves, I would say, not all of them, but several of them who were involved in some of the early efforts with the Department of Commerce and sort of talking to policymakers about what cyber insurance might look like, we're somewhat promoting this view as well. We're saying, look, we're going to be collecting data. This is what we do. We assess sort of how you drive down risk, and we collect a lot of claims data, and we're able to make really informed decisions and recommendations and requirements of our policyholders. And I think one of the points that I want to make today is that that has not happened. Right, we have not seen any ability of the cyber insurance market to drive down cyber risk exposure among policyholders. And more than that, I would say we haven't even seen insurers able to make any more sort of data-driven or empirically informed assessments about specifically what works for cybersecurity to help protect against these incidents. So when I talk to insurers, which is something I do a lot of, right, if you ask them, well, in all of your claims data collection for the past several years, are you able to sort of draw any correlations between, look, if you're using really strong encryption, you're less likely to have large losses, or if you're using multi-factor authentication or whatever else it is. And what I hear from multiple insurers is, well, we're not there yet. We don't have any sort of data that shows correlation between preventative measures, by which I mean sort of the security things you do to prevent losses. What we do see, some of them say, is that if you bring in lawyers really early, Sometimes that means there are smaller third-party losses, there is less spent on litigation. So that's been sort of one of the big pushes, is seeing insurers partner with law firms and sometimes with other types of security firms to kind of encourage policyholders, either before an incident or after an incident, go talk to one of these law firms that we've endorsed, go talk to one of these companies that we believe in, get their services, get them on board quickly. And I think that actually often works at cross purposes with trying to collect the kind of data that we would need for long-term cybersecurity improvements. So one of the things that insurers also often say to me is, we bring in the lawyers, they're great at sort of managing some of the liability risks, but they also often tell our policyholders, don't conduct the in-depth, what we might call root cause analysis of this incident, don't share that information with anybody. Sort of all of this needs to be as locked down as possible. I've had insurers say, we can't even, as the insurer, get access to information about how incidents happened because the legal counsel who we have recommended that our policyholders bring in is saying that that can't be shared, that can't be sort of given any more publicity or availability, because that would increase the risk of a lawsuit, that would increase the risk of liability. And so I think the dream that sort of cyber insurance idealists perhaps had, that this was a market that was going to really help us drive down cyber risk exposure, feels further away than ever right now, where it feels like we have ransomware on the rise. We have no very concrete ideas about what we should be requiring of people who hold insurance that covers ransoms to tell them to do to avoid being actually hit by ransomware. And at the same time, we think, though we don't have great data on this again, more and more people paying those ransoms, not just because they have insurance coverage, but often, as in the case of Colonial Pipeline, in consultation with their insurers presumably saying, yes, go ahead, pay this ransom, we'll cover it. And that is very directly funding the cybercrime industry, right? That is very directly contributing to more cybercrime, more money that will encourage other people to go into this criminal enterprise because they see how lucrative it is. And I think there we see this trade-off between the short-term goals of the insurers and their policyholders who want to, get everything back up and running as quickly as possible. And if there's any chance that making that payment is going to help with it, even though, as you heard, that's not always the case, you're going to go ahead and pay that money, versus the long-term goal of trying to drive down ransomware overall, potentially by making it a less lucrative enterprise, by trying to discourage these types of payments. And there's also this lack of clarity around kind of what insurers feel they're allowed to do. A moderator mentioned in the opening remarks, right? AXA has announced in France they're going to stop covering ransoms. That's not a moral choice on their part. That's not them saying, we think this is wrong to be giving money to criminals. That was actually AXA saying, look, we are so confused about what the regulatory situation is in France that we went to this hearing and some regulators kind of alluded to the idea that it might be illegal to cover these payments. So we're just going to stop until there's clarity. So definitely, I think sort of the need for that clarity, the need for some better sense of sort of what policymakers view as permissible. And this is not a failing necessarily of the insurance industry. I think this is very much a failing of the sort of back and forth we've seen from law enforcement around, look, we don't want you to pay the ransom, but we know sometimes you maybe are going to pay the ransom and we want you to work with us anyway. And so there's been a very sort of confusing, I think, narrative coming out of the US government in particular, but many governments, about those ransom payments that has left both insurers and policyholders a little unclear on, so we can pay ransoms, but we're maybe not supposed to, and we're maybe not allowed to if we're making payments to specific sanctioned groups that the Department of the Treasury has said you're not allowed to pay ransoms to, but you don't always know who you're paying a ransom to. And so there's been a lot of sort of words and very little clarity around what any of it means. Couple points that I want to make today from the cybersecurity side. I think that there's still hope to me that insurance could eventually get to a place where it was able to drive down risk exposure of its policyholders. We're definitely not there yet. I don't think we're anywhere close to being there yet. I think sort of if you look at that list of controls that Matthew McCabe put up of sort of here are the things that companies are being required to do to hold insurance, all of those are controls pretty much with some exceptions where there is a huge variation in implementation, right? So if I say you have to have endpoint protection in order to get insurance, that can mean 1,500 different things. That can probably mean more like 10,000 different things, right? And some of those are probably helpful and important and useful. And some of those are just sort of money being thrown into the garbage for somebody to come in and install a lot of extra software on all of your devices. And the thing we're missing is the ability to sort of drill down a little bit more and say which of these implementations, which of these sort of specific forms of segmenting or dividing up your network, of protecting your endpoints, of protecting your network are actually going to be effective. And I would love to see that happen. I used to think, and I still think to some extent, that insurance could play an important role in that, in trying to collect some of the data that's needed. I think more and more actually that that's probably not going to happen unless there are regulatory requirements that force insurers to aggregate and collect some of that data and share it in ways that will actually enable some of that analysis to make better data-driven decisions about what the cybersecurity recommendations that we're making are. I think the point that Peter Halpern just made about treating victims as victims is a really important one, but I want to add to it that victims are not just victims. They're also, you know, incredibly key players in the defensive ecosystem of cybersecurity. And we, as people who work in cybersecurity, as regulators, as insurers, need to do a much better job giving them the information and the guidance and the tools that they need to defend themselves. But they also need to be able to do a better job sort of implementing that advice and taking that really seriously and making sure that there are incentives in place, that they don't feel that they are buying insurance as a replacement for investing in cybersecurity, right? As sort of like, okay, this is our incident response plan now, is we call our insurer and they tell us what to do. I think that's also a sort of dangerous path to go down in terms of thinking about the long-term future of cybersecurity. So I'm going to wrap up there because I do want to leave time for questions. I just want to emphasize that I think sort of compensating victims and making sure that people are not losing exorbitant sums of money on cybersecurity incidents is a really important piece of what insurance can do. And I think perhaps to many insurers, it's the main thing that insurance is here to do, is to compensate victims. For me, for people who work in cybersecurity and care about the question of how do we do a better job defending against these attacks, there's also a really important piece here that I would hope insurers would also be invested in, would also be sort of actively working towards, which is how do we do a better job of driving down our risk exposure? And what does that mean? And how can insurance play a real active role in collecting the data that we need to know how to do that and to inform policymakers, right? I think there's this back and forth where policymakers often say, oh, well, you know, we're not totally sure what we should be requiring for cybersecurity, but we think insurance is going to play an important role in sort of market-driven solutions to that question. And then you hear insurers come back and say, well, you know, NIST promoted this cybersecurity framework, and so that's what we're asking people to do, when we actually don't know how much does the NIST cybersecurity framework help. Is that actually a sort of effective tool for managing cyber risk? And so I think that sort of a little bit more honesty and a little bit more clarity between regulators and insurers about the role that each one plays, how much information is required to be shared between them, and how much uncertainty we still have about what we should be requiring and how to drive down exposure to cyber risk would be helpful in this space. So let me stop there so we have at least 15 minutes for questions.
Thank you, Dr. Wolf, and thank you again to all the panelists this morning. Once again, a very timely and important issue that we're discussing here this morning. We do have some time now for questions or comments. We'll start with Representative Meskers.
Thank you very much. You know, when we listen to the commentary about cybersecurity, I think the framework I look at as a legislator is the reverse of what we've been talking about most of the last couple of days, which is state versus federal action in terms of regulatory frameworks. If you look at the ransomware attacks, there's a crossover question between cyber warfare and cyber crime/espionage and the framework we're dealing with of who the characters or actors in this market is. trying to develop an insurance policy when you have nation states involved in developing cyber warfare or cyber attacks and ransomware, and leaving that to the private sector to develop defense mechanisms and the insurance industry to cover it. I think we need a policy framework coming from Washington about how engaged the federal government is going to be on the ransomware platform that's coming out of nation states, so we can frame the risk, because we have an evolving risk that I don't think we're capable of insuring because we don't know how the risk is going to attack the industry. It doesn't obviate or limit the need of corporations to improve their game every day. But when you have enterprises of nation states who are dedicating resources to cyber warfare, ransomware, how many corporations are going to be capable of building a firewall to defend against operatives in a foreign country, whether it's China or Russia or North Korea? So we've got a bigger policy issue that if the government doesn't step in from, it's very hard for us to frame insurance coverage, liability for the corporates when we've got actors of that magnitude. You're basically the typical expression, you're bringing a knife to a gunfight. And the question is, I don't know where, to me, there needs to be more emphasis from our group for federal policy in terms of what intervention the government is going to take in this cyber crime.
Mr. McCabe, you have any thoughts on that? Your bio says that you spent some time as a policy director with the Homeland Security Council, so
Sure.
you might be well suited to address that.
Sure. I completely concur, and I would commend the Biden administration that they've been putting efforts behind the policy development. It has been slow going. Ann Neuberger, who is the new head of cyber for the NSA, has said in her own comments that over the past 10 years, we haven't made enough policy progress. I do want to address, though, this tying of ransomware to the insurance industry. So everybody should take back that insurance has nothing to do with the proliferation of ransomware. Ransomware happens for 3 different reasons. Companies remain vulnerable. The criminal organizations who are carrying out the attacks are safe harbored in jurisdictions of our adversaries. And number 3, cryptocurrencies allow payments to get made and eventually filtered into their pockets anonymously. Those 3 factors promote ransomware. The thought that insurance is promoting ransomware is relatively absurd. So if you are an insured who is attacked, you are the one with the incentive to pay, right? If my business is down and I'm losing income, I have an incentive to pay, and the potential is that I've gone out and insured against that. So now I'm the one turning to the insurer and say, hey, my company's down and I need to get back up and I need to pay this. It is the insured who makes the decision. The decision by the insurer is mostly, at this point since the September guidance, is this going to violate an OFAC sanction? And if it's not, this is what I've signed up to agree to. For the federal regulators who are starting to say that the insurance industry shouldn't be making all these payments, they are lucky that the insurance industry is making these payments. Because if it wasn't for the insurance industry spreading this risk, they would have some very, very angry companies looking to them on why are our foreign adversaries able to safe harbor these organizations, and how are these cryptocurrencies getting payments to them? Those are the policy initiatives that need to be addressed. And I would also say, for the thought that the insurance industry is not hardening cybersecurity, that is not true as much as it is the gap that is growing. So for the number of endpoints that we're putting into play, we're involved in the 4th industrial revolution, where we are attaching everything to the internet. Devices that we never conceived would be attached to the internet now are. And exposure is growing at a rate, and unfortunately, insurance looks back. They look back on what just happened, and they have to say, well, let's fix that, make sure it never happens again. But we're not progressive that we stay ahead of it. We are learning, but we're learning at a pace slower than the risk is growing.
Thank you. So And Matthew, Mr. McCabe, you mentioned earlier that premiums are increasing and capacity for clients is decreasing. Are there certain industries or sectors who are at risk of not having access at all to cyber coverage in the future? And if so, who do you think who is most at risk?
I mean, sadly, I would say that municipal organizations and townships and states are often viewed as the toughest risk. There are other really challenging risks. Healthcare has always been a highly targeted industry. I mean, municipalities really have a rough go of it, and it's usually seen because they're decentralized systems that budgetary concerns might harm your ability to keep up with. There was a study on the federal government about software lifecycle that if you look at Goldman Sachs, the software lifecycle was somewhere around a year, and in the federal government, it was somewhere between 15 to 20 years on improvement. And that's the burden that they act against. So, I don't know if I want to reach the point of uninsurable, but certainly very difficult. And you're probably looking at less capacity available, and you're probably looking at very, very high retentions escalating and fortunately escalating premiums.
Thank you. I think we have a question from Senator Hackett.
Yeah, I appreciate it, and I agree with Dr. Wolf that it's really a work in progress. No one's really commented about what we did in Ohio, and I realize ransomware is a different security issue than a lot of the other issues. But in Ohio, we met for over a year, and we discussed it. How do we do this? But we wanted to incentivize the business community to come in, and so what we did, we passed a law that basically said if they adhere to one of the 8 standards or 10 standards, and those standards are changing, and a lot of them are industry standards. And there's a problem, and I like NIST very strongly, but NIST has unbelievable number of standards. So I think it was up to the industry associations to look at NIST and say what standards fit our industry, et cetera. But what we did in Ohio is then we basically passed a law that said if the companies did this, they would actually get an affirmative defense in the court of law, and that would help them in these issues against these class actions. But the problem we ran into, and that's where I worry about the insurance industry, we had to protect the small companies versus the big companies. And that was the only thing that worries me sometimes is the insurance industry will come out with a policy, et cetera, that's so hugely expensive that it'll run the small company out of business. They'll just say, we just can't do that. And so the standards for a small company are tremendously different than the standards of a large company. But we didn't know if what we were doing was right in Ohio. We don't know if it's working, if it does, et cetera. But I didn't see any comments. I don't know if you or Dr. Wolf would like to comment on what Ohio did.
Yeah, I am familiar with similar ones, and go Buckeyes, of course.
Yeah.
And I know the great state of Connecticut, which is now my home state, has a similar law that just passed where there's an incentive that if you're fulfilling certain standards, you get a liability protection. And it's a tremendous effort. It is absolutely going in the right direction because you're rewarding the companies who are being good actors right now. That type of private sector incentive, I cannot promote more so. The disparity between small versus large, it's unfortunately not the only way that impact is felt in small companies versus large companies, and large companies having the capability to do certain things. I would say in our industry, what to often look for is a small company trying to utilize cloud solutions that might make defenses of which they would not otherwise be capable possible for them. Now, there are tying issues with that. Tying might be an ugly word to use, but if I'm big software company X and I say, yeah, I have an endpoint detection response solution that you can buy, and it's really effective against ransomware, I package it with these 50 other things, and you have to make the decision on whether you're going to make the budgetary spend. It's like buying your cable solution. I only wanted the one channel to watch sports, but now I have 50 other channels that I had to pay for. And that's kind of the model that they're working on. It would be great to see more flexibility in that for smaller companies because cloud solutions are really, really positive for these companies to take available. It's just often a budgetary concern.
So I
Go
would
ahead.
just, I think the most important thing in what you just said is we have no idea if this is working. And I so tremendously admire, and I say this absolutely in earnest, your ability to say that, because I think so many people working in cybersecurity, working in cyber insurance are unable to acknowledge that sort of what they're doing is just an experiment. And I think that's exactly the right thing to be doing right now, is to be saying, look, we don't know what works. Right, which is absolutely true. We're going to try this thing where we give you some liability protection, where we see whether that seems to improve outcomes. I hope you're collecting a lot of data on this. I hope you're mandating that the insurers who are involved in this in any way are releasing some aggregated claims data. I hope you're really carefully tracking this in all possible ways you can think of, so that you can come back to it and reevaluate it and say, are these the right protections to be granting people some immunity for, right? Has this actually been the best response or an effective response? And I think if you're doing that, and you're doing that in the spirit of, we're going to try something, we don't know if it's going to work, but we're going to collect a lot of data and measure it and reevaluate it in a year or two, then you're doing exactly the right thing. And what I most admire, as I say, is that you're doing it with the open acknowledgement, we don't know if this is working, we're going to need to collect a lot of data, we're going to need to reevaluate it as we go.
Thank you. We'll take our last question or comment this morning from Representative Thomas.
Yes, I had a question about Ohio and Connecticut. They passed these. So I find this space to be changing at such a rapid pace that I fear passing a bill that has criteria that is good this year and needs to be modified next year. So my question is, in your legislation where you've seen it, maybe you're best to answer, you've seen it across the country, is there kind of open-ended, ever-changing criteria? Because otherwise, you know, what's the right thing to do in 2020? As you've said, in 2022, just 2 years later, might be old security that they found a way around, and now there's a new standard.
You know, I answer it like there's great thieves, and the thieves are always changing. So I think the Ohio law is always evolving, and the standards will keep changing. We just want that when the company goes into court and there's a potential class action, they can see that that company at that point in time did what their industry standard did, and they should have protection against a class action suit. So that's why, but I agree with you 1,000%, because it's because the thieves are so good. Ask anybody in the room about the unemployment issue we dealt with. It's unbelievable how much money was stolen on the unemployment, but that it is an evolving process.
Thank you again to our panelists this morning and to all the members for participating on this early Saturday morning. We will adjourn this meeting and take a 15-minute break before the Health Committee starts. Thank you all.
Long-Term Care Issues Committee. My name is Pamela Hunter, Assembly Member from the great state of New York. We are going to get started. So we want to call the roll, but we're going to hear from Zoom legislators. If you could please introduce yourselves.
Senator Jason Raper. Representative Tom Oliverson.
Assemblyman Ken Cooley in California.
Representative Edmund Jordan, Louisiana.
Chad McCoy from Kentucky.
Jim Gooch from Kentucky.
Deanna Frazier, Kentucky.
Any other legislators on Zoom? Okay, if we could go around the room, please, so you can identify yourself for the minutes. We'll start at the end.
Yeah.
Mr. Chair.
I'm sorry, Representative Lehman, State of Indiana.
Paul Etke, Minnesota.
Representative Bowe, North Dakota.
Senator Burkhardt from North Dakota.
Representative Stone from Michigan.
You don't want to hear shot.
Representative Meskers, Connecticut.
Representative Ferguson, Arkansas.
Representative Rowland, Kentucky.
Assemblyman Kevin Cahill, New York.
Delegate Steve Westfall, West Virginia. Representative Joe Fisher, Kentucky.
Senator Bob Hackett, Ohio.
Senator Matt Pitch, Arkansas.
Representative Wendy Thomas, Pennsylvania.
Okay, can we have a motion to waive the quorum, please?
So moved. So moved.
Second. All in favor?
Aye.
Opposed? Abstentions? And can we have a motion to approve the minutes of April 16th, please? Second. All in favor?
Aye.
Opposed? Okay, we are changing the order of the meeting, and we are going to start with the introduction and discussion of the NCOIL Accumulator Adjustment Program Model Act. So we're starting with that. Before we get to our speakers, if we could have comments from the main sponsor, Senator Raper, please.
Thank you, Assemblywoman Hunter and Madam Chair, and also Representative Oliverson and I are here together. And sorry that we couldn't be there in person at this moment. I'll be brief. I'm really looking forward to being there in person at our next meeting in Scottsdale in November. I'm proud to sponsor this model law as it mirrors a piece of legislation I sponsored in Arkansas that was signed into law just a few months ago. In fact, this type of legislation has been a growing trend across the country as states such as Arizona, Kentucky, Georgia, Illinois, Oklahoma, Tennessee, and Virginia and West Virginia have all passed legislation on this issue. The issue that such legislation and this model act deals with is that it seeks to prohibit accumulator adjustment programs which prevent co-payment assistance that helps patients pay for high-cost prescription drugs from counting towards their annual deductible or maximum out-of-pocket cost. I truly believe this is a good consumer bit of legislation. When families are strapped already, this allows people to be able to enjoy those benefits for themselves rather than them being taken up by a greedy middleman in the process. Accordingly, the model and the laws across the country simply state that no matter who is paying for these funds, whether it's pharmaceutical manufacturers, copay systems, a GoFundMe page, or an aunt or an uncle, those funds and third-party payments should be counting towards a patient's cost-sharing requirements. The language you see before you, members, on page 374 in your binders essentially mirrors the language that was discussed during our last committee meeting that is supported by the American Medical Association. And I do thank them and want you to hear these people of the American Medical Association, the American Cancer Society, Cancer Action Network, AIDS Institute, the National Hemophilia Foundation, the Cancer Support Community, the American Kidney Fund, and many, many others. What's great about this issue is that it is truly bipartisan. Both red states and blue states have enacted legislation on this issue, and I'm thrilled that my colleagues and committee members from both sides of the aisle have joined me in sponsoring this model. Madam Chair, Assemblywoman Hunter from New York, and Madam Vice Chair, my colleague Representative Deborah Ferguson from Arkansas, have both signed on, as well as former NCOIL President Representative George Kaiser of North Dakota. And everyone knowing George and how much I think of him and I think of my other colleagues, I'm really excited about the opportunity to put this forward with them. So I look forward to the discussion today, and I'm confident that we can get to a place where the model is ready and adopted at our annual meeting in November. And so I appreciate, for the purposes of the committee, Madam Chair, that we're getting this introduced, and we look for robust opportunities in the future as we head into November to talk about any ideas or suggested amendments if they're out there.
Thank you very much, Senator. We're going to go into our discussion. If we could have Colette Koulianos from the All Copays Count Coalition representative, please start. Following her, we're going to hear from Brenna Papard from AHIP, and I believe there's someone here from the American Bankers Association. Both Colette and Brendan are on Zoom. The representative from America's American Bankers Association, if they're present, if they could come forward, please. Colette, please.
Colette, you're on mute.
I'm sorry. Actually, my colleague Stephanie Hanks from the AIDS Institute and also part of the All COVID Account Coalition will be presenting as well, and she's up first, if that's okay.
Go ahead, please.
Great, thank you so much. Hopefully you can all see my screen at the moment as I walk through these slides. And I apologize, I'm going to be speaking fairly quickly, but there's a lot to cover in a short amount of time. So again, my name is Stephanie Hengst, and I'm with the AIDS Institute. And I'm also a member of the All Copays Count Committee steering committee, along with Colette. And we're just going to jump right in. So at the AIDS Institute, we have been working on this issue for quite a while now, and it's part of our larger work on health insurance benefit design and looking at how those benefit designs are structured, the ways in which they're changing, and the ways in which those changes are putting more financial responsibility onto patients. And we know that patients are already subjected to utilization management techniques such as step therapy or prior authorization. And so now we're seeing copay accumulator adjustment programs or policies on top of that. And copay assistance has really helped patients with all these changes to help afford their meds, which ultimately also reduces health inequities in healthcare. So that's kind of how we've come to this issue. And as part of our contribution to the advocacy has been to document how common these copay accumulators are and how they've proliferated in recent years. So in a report that the AIDS Institute published earlier this year, I did some background research and looked at all of the ACA marketplace plans across all of the states. So we looked at all 45 states plus DC. We had pulled out 5 states that, as previously mentioned, had passed legislation going into the 2021 plan year. But when we looked at all of those other states, we saw that every single state had at least one plan in their marketplace with a copay accumulator in it. And then when we broke that down even further, there were at least 14 states that had a copay accumulator in every single plan. And so here's a nice visual of kind of what the landscape looks like across in terms of percentage of proportion of copay accumulators within them. And you might say, you know, I live in an orange state where residents have a 50-50 chance of selecting a plan that may honor their copay assistance. However, then you get into network adequacy issues where, you know, many people may be living in an area or a region where there's only one issuer offering plans, and their chance may be that one plan has a copay accumulator in it. And bottom line for patients like those living with HIV or hemophilia or other rare diseases is that they're really having no options to select plans that's going to honor their copay assistance and have it counted towards their out-of-pocket cost as it is intended. So these next 2 slides, I'm going to go kind of quickly, but they're also included in the slides that I think are going to be shared, and then also in that report that I mentioned that we published. But what they demonstrate is that over the course of a plan year, what a patient pays out of pocket, and then ultimately what the insurer or the PBM is collecting. So when there's a copay accumulator in place or a copay maximizer, there's variations on these policies. The insurer and or PBM is collecting a significant amount more than under a standard plan design when there's no copay accumulator in there. And ultimately, you know, when the patient is paying all of their money up to that annual limit, on top of that is the copay assistance that's being collected. And copay assistance is not a discount, it's still money that's being collected. And so these programs, these accumulator programs are really can be thought of as an income generator for insurers or PBMs. So this slide also shows what Senator Rappert was discussing at the beginning, how at the beginning of 2021, there were already 5 states that had passed legislation. And since the spring, it's been kind of like a popcorn effect with lots of other states passing legislation, which has been really great. Lots of advocates have been working with their local legislators to introduce legislation as well. As you can see in many other states, there are now 11 states that have passed legislation, plus Puerto Rico. And we're hopeful that in the coming session that there'll be much more success with all of this momentum happening. So the All Co-Pays Count Coalition has drafted model legislation that NCOIL is considering. And as you know, this is the legislation that has largely been utilized in the states that have passed legislation and that also has been introduced. It's very short, sweet, to the point to address the issue. And what it does is require an insurer or a PBM to count payments that are made by or on behalf of the enrollee towards their out-of-pocket costs. So again, it's very simple. It addresses the issue and will protect patients and their copay assistance so that they can afford their medications. There's a lot more I can discuss about this matter. I'm happy to connect with anybody offline if they're interested in state-specific information, but I'm going to pass it now on to Colette because she has some things to share from her perspective as well.
Yeah, thank you very much, Stephanie. And I'll have you. So I'm Colette Kulianos, Senior Director of Payer Relations with the National Hemophilia Foundation and one of the founding steering committee members of the All Co-Pays Count Coalition. So next slide. So basically, and I don't know what happened here with my slide deck. This is, sorry, because it's not reading correctly, but so basically what is copay assistance? We're talking about coupons, discount cards, or other programs provided by either manufacturers, nonprofits, and as you heard at the beginning, grandma, grandpa, aunt, uncle, a GoFundMe page. There are various mechanisms in which patients have had to get help in order to be able to receive their life-saving treatments. And when do patients receive the assistance? They receive the assistance only after a doctor or their physician have deemed the right therapy to meet their treatment costs, and only after the insurance company has already stepped them through the prior authorization process, you know, make sure the drug is on the preferred drug list, so it's not circumventing any plan design. High deductible health plans. So we did a survey along with other chronic disease groups in at the beginning of this year. 55% of patients with chronic diseases say that they're on a high deductible health plan. The income levels, so 69% of the individuals with an income under $40,000 have a high deductible health plan. And also very alarming is 33% of patients surveyed say that they're unable to afford their medications or treatments because their copay assistance ran out or persons of color. So next slide, please. So there are racial, ethnic, and income-based disparities that exist here. We look at even just the lowest, the silver plan on the marketplace is the average deductible on silver plans on the marketplace is $4,879. So this is absolutely unattainable for so many people to be able to hit that kind of deductible, and your insurance doesn't pay until you've reached the maximum. You've paid the entire deductible. And so I'm clear, when you have a high cost chronic disease like hemophilia or the other conditions that have been mentioned, you have to, the assistance you receive is capped. So even if they allow the assistance, which is what the insurance companies are saying, you can use the assistance, but it doesn't count. So by month 2 or 3, that assistance is run out for the year if you have a $4,879 deductible. In the first couple of months, it runs out, and then the patient has to bear that full responsibility before they can get their meds, or they're held accountable, or they're held hostage at the pharmacy counter, literally. Next slide, please. So health plans are changing the rules on the way this assistance program counts. We're asking lawmakers to enact policies requiring health plans to count the assistance. And again, I'm apologizing for the way these slides are reading. I think it happened when we merged them together, I'm guessing. And the last slide, Stephanie. And legislation does not conflict with existing guidance. The, you know, as we heard from the opinion of the Louisiana Insurance Commissioner on high deductible health plans, and the clear intent of HHS's regulation on the NBBP was to allow states to make the decision. And we have gone back to them on multiple occasions, and they said a plan does not have to have a copay accumulator on it if it's an HSA. That's up to the plan. So that is, you know, I'll end there since we're on a time limit, but I also have my contact information within the slide deck and happy to speak to anybody offline. Thank you.
Thank you so very much. Brendan, please.
Chairwoman Hunter, Vice Chair Ferguson, members of the committee. I am Brendan Popard with AHIP. Thank you for the opportunity to speak on this issue today. good to see you all again. I hope that I will be there in the fall because I really would like to see you all in person. Rising drug prices impose a heavy burden on all Americans, a direct result of high list prices determined solely by drug companies. While pharmaceutical companies are posting record profits, too many hardworking Americans must choose between paying their bills and accessing life-saving medicines. You already know from our previous testimony that we believe that coupons are tools intentionally used by drug manufacturers for financial gain, allowing them to skirt their responsibility to lower drug prices for all Americans. As you know, the federal government protects taxpayers from this scheme, prohibiting the use of coupons in certain markets. Pfizer is currently litigating this issue to attempt to undo this prohibition, and according to one of HHS's lawyers, quote, to upend decades of settled law and agency guidance in this highly regulated space, unquote. We've given you information on our concern with coupons in our written comments, so I won't focus any more on that today. Instead, I will talk about the problem that you have clearly identified, the high price of drugs, and how that makes it difficult for people to afford their prescriptions, and some proposed amendments we believe will help improve the model and get at the problem. Before I discuss that problem and the amendments, I would like to reiterate that we believe this model in its current form is harmful in that it does nothing to address or control high drug prices that drug companies alone are setting, and it takes away a lever that health plans have to control the market manipulation created by coupons and hold drug companies accountable. Now, I would like to turn to the problem you have identified. 96% of voters agree that lowering drug prices is an important challenge facing Americans, and 86% of voters say drug makers are responsible for rising prices. This model, as drafted, does not address the high prices, but instead it narrowly focuses on the out-of-pocket costs facing certain individuals. Out-of-pocket costs for all services, drugs, and devices are based on the underlying cost of the product or service. Since the model focuses on limiting the ability of health insurance providers to properly account for out-of-pocket spending in some circumstances, instead of on the problem of high drug prices, we think the committee should consider some amendments. These amendments get at the fair and equitable offering of the aid from drug makers and expands on the good work of transparency already begun by NCOIL. In the purpose section, we recommend that the committee remove language that is incorrect. First, make clear that drug costs are high because manufacturers set high list prices. More importantly, remove the incorrect assertion that insurers use accumulator programs to, quote, double dip. At no point in the use of coupons or other cost sharing assistance do health insurers or PBMs receive the value of the coupon. Generally, a coupon is created by a manufacturer, given to a patient, then it goes to the pharmacy along with any remaining consumer payment. The value of the coupon is therefore given back to the manufacturer as payment for the drug. Health insurers and PBMs may not even be aware that a coupon is being used because coupons include their own identifying information that results in them being processed separately from a consumer's insurance. Now, turning to the body of the model. First, we recommend that you limit the accumulator ban to cover drugs that have no lower cost alternative. This model should not facilitate drug manufacturers' efforts to circumvent formulary management and give patients the ability to go off formulary for the same price. That will just harm our ability to negotiate lower prices for all consumers in the future. Instead, limit the manipulation of pharmaceutical manufacturers where there are less expensive options available, either as a generic, another brand that the insurer has placed on a lower formulary tier, or when the drug is available in an alternative form. Next, require patient assistance to be provided to all enrollees for the entire plan year and require advance notice of discontinuation. This amendment is entirely for patient protection. Patients who rely on medications for long periods of time should not be concerned about their assistance being halted suddenly. Additionally, if patient assistance is allowed, manufacturers cannot be allowed to discriminate when deciding who can use a coupon. Finally, provide additional transparency to understand the full impact of third-party payments on healthcare spending and aid in health insurance provider ability to administer this model. We applaud NCOIL's past transparency efforts As mentioned, health insurance providers are often not aware that a coupon is being used because coupons include their own identifying information that results in them being processed separately from a consumer's insurance. Without inclusion of the notice we recommend adding, there is a risk that health plans will have difficulty complying with this model because we may not know that a coupon has been used. Thank you for the opportunity to speak, and we stand ready to work with you on any amendments that you consider. Thank you.
Thank you, Brendan. If we could have the folks from the American Bankers Association, I believe there's a couple of you here. If you could say your names, please.
Happy to do it. Can you hear me just fine?
Yes, sir.
Okay, very good. Thank you for entertaining our comments today. I'm Kevin McKechnie. I'm the Executive Director of the American Bankers Association's Health Savings Account Council, and we represent 94% of all the HSAs in the United States. We can tell you from our research that is just now available, based on 2020 data, we insure 1 in 3 working Americans, not ourselves, of course, but the companies that are members. And that nets out to about 65 million people in the country that look to HSA qualified insurance to finance their entire major medical experience. And we're here to visit with you today because, and there's an irony, I find myself visiting with you all the time to talk about what the IRS says a high deductible health plan is, and it's the irony of my career that I tend to represent the IRS pro bono at this point. I don't want to do that much anymore. They are the arbiters of what a high deductible health plan is and what it isn't. They are the arbiters of what an eligible individual is, and those two things have to match for someone to be able to contribute to their health savings account. And so we're not here today to offer comments on whether or not a copay accumulator is a good idea or not, or what the relationship with that to a drug company may or may not be. We're here to offer comments about how it affects a federally regulated high deductible health plan and affects the 65 million people covered by them and their ability to contribute to their account. And here's why. When there are coverages that the IRS determines are other coverages, which are prohibited, you lose your contribution eligibility. And usually that means the high deductible health plan ceases to be a high deductible health plan. And in any event, if one or the other happens, you're no longer to keep your major medical insurance and you have to find alternate coverage. And so we've seen this in the past, and so have you in your capitals, when people talk about this procedure or that procedure, breast cancer screening, colonoscopy screening, that should be done without cost sharing, a perfectly laudable goal, except that if you have a high deductible health plan and you're an HSA contributor, a bill like that cancels your eligibility and throws you off your health plan. You have to find some other health plan. And so we've gone from capital to capital, and we've said, these are perfectly reasonable bills. We're not here to debate them. What we're here to suggest to you is that you provide a carve out for people insured this way, so that to the extent whatever mandate you're discussing may affect their contribution eligibility, it would not affect their contribution eligibility. That means you're able to go forward with your plans and your capital, and people insured with these plans are able to keep their plan going. We want to note for you, we've sent to NCOIL staff a letter the IRS wrote to the state of Illinois, where they, and I'm sorry to say, took an exactly contrary view to the information you saw in the presentation. A copay accumulator strategy is completely in contravention of IRS rules. Now, there is something else to look at, and the reason we're asking for a exception to be made in this case is because we have looked through the carriers that we do business with that are on our board. None of them process claims in exactly the same way, and we don't have any intention to force them to, which is why the exception seemed to make more sense, because it was easier to accomplish and it let other businesses continue to do business the way they'd always done before. But I wanted to offer an example that's from the IRS letter. If a drug costs $500 and the coupon was $400 and it was going to net out to $100, IRS says that that $100 is what goes to your out-of-pocket costs. That's it. It would be perfectly reasonable if the coupon for $400 was contributed to your account, because as Senator Rayford says, and he's right, anyone can contribute to an HSA and it's deductible to you. Your aunt can, your company can, your grandfather can. We have no trouble there. And if that's how this issue plays out for HSA qualified people, well, then great. That means that people have money in their account. That's not how the issue is playing out as a practical matter today with respect to how these claims are adjudicated from carrier to carrier. And because that's the case, what we're asking for is there be an exception made in your model law for people insured with plans manufactured by under IRS Section 223, which is the HSA statute. Thank you. Happy to answer questions. We've brought Mr. Klein here, our counsel, infinitely more knowledgeable on these questions than me, but we can accommodate the chair at your leisure. Thank you.
Thank you. For those folks who are participating via Zoom, legislators, if you could make sure you use the raise hand function for questions. Any legislators here, if you are interested in asking a question. And just from me, or do you have proposed language that you would be forwarding to us relative to your recommendations?
Yes, ma'am. We will have that ready for you almost momentarily. We're perfecting the language now.
Okay, thank you. Questions? Yes, Representative Thomas.
In states that have passed this, does it only impact the fully insured plans because the self-insured plans are guided by ERISA? I don't know if anyone can answer that.
Is that for me? I can answer the question if you'd like me to. Well, I'll take the opportunity. We're at the case that states decided this is how these claims would be adjudicated. It would affect fully insured plans for certain, because you are in charge of what insurance is and what it isn't within your borders. The IRS is in charge, like I said, of determining what a high deductible health plan is nationwide. And so this is where the conflict arises, which is if a state insurance department or a legislature says this is how we treat drugs in our state and how we think these claims are adjudicated, and it's in contravention to the way the high deductible health plan rules run, then that's where the disqualification problem arises.
So I understand with a high deductible health plan, I understand that, but I'm asking more a self-insured plan versus a fully insured plan. Because it's my understanding as state legislators, we cannot legislate requirements for self-insured plans.
Yes, that's right.
And 7 out of 10 people, at least in my state, are covered under a self-insured plan. So I'm not opposed to the model legislation because I think it's good. I'm trying to be clear if, and particularly because some states have adopted it, in those states where they've adopted it, I'm just confirming, my belief is it only impacts fully insured plans. So is it a question?
Do we have, Brendan, or the folks from the All Co-Pays Count have any response to the question? If not, we can definitely get that answer for you.
The answer on the high deductible health plans is correct. It doesn't health plans, that's governed through ERISA.
Yeah.
This is Representative Rowland from Kentucky. We did pass a similar bill this last session, and it is my understanding it only applied to fully insured plans. It did not apply to ERISA or self-insured plans. So it even did not apply to the state employee health plan in Kentucky because it is self-insured.
I was simply going to say I am not familiar with all of the laws that have passed, but it would be my understanding, generally speaking, that they would only apply to the fully insured plans.
Madam Chair, I just wanted to add a couple of comments to Kevin's excellent presentation. He's a longstanding expert on this. I'm Jeff Klein. I'm of counsel to the ABA HSA Council through McIntyre and Lemon. Used to work for a carrier and a broker, so I've done about everything. Working this issue may be easier than working the microphone, so I apologize for that. I wanted to make the point that we understand as we're following these bills in state capitals and before your organization, this is intended to be a consumer protection device. So if I can make a very simple comment, even though we obviously have a proprietary interest in HSAs, we don't want there to be an unintended consequence for those who have their own HSA accounts and be restricted from using them, whether it's for female reproductive services, opioid or insulin treatment, and all that we've seen here. So our intent is aligned with yours and not in any way intended to derail the bill. The second comment I wanted to make, we saw some maps about legislation that has been drafted on copay accumulators, but we've also been pleased to work with many of your members in the state houses around the country in Arkansas, Kentucky, Iowa, and Nebraska. And in Arkansas, Kentucky, we actually got a fix similar to this model, and our proposal that we've submitted to the co-chairs and will is based on an Arkansas bill, Senate 664. And there were several bills in Iowa and Nebraska that were introduced but weren't passed. So we are trying diligently wherever we can. And it's a problem because it's a defensive action and it's an uphill battle. And the third comment, in the interest of time, because the co-chairs allowed us 2 minutes and we've gone over that. The NAIC is actively concerned about this as well. NAIC Health Committee staff, which is about the best that we've seen in any of the committees there, including Brian Webb and Jolie Matthews, have recently surveyed their insurance departments, and the Illinois IRS letter has been widely distributed among departments of insurance, so they are looking at that issue and have similar concerns that we do. So thank you for having us here today. It's great to see everybody in person again, and we appreciate you allowing Kevin and I to testify.
Thank you so very much. We're going to go to Representative Ferguson to close, and any comments or amendments or recommendations, suggestions from any of interested parties, please make sure you forward. We would like to close this out at our annual meeting in December. So, Representative.
Well, I was going to ask a question, but the best thing in the interest of time, I know there is some disagreement about the IRS notice and if that is actuality, if it does apply. So maybe at the next meeting, we could hear from the opposing side on the IRS notice, because I know there is some disagreement on that issue. But the bottom line, I mean, we can't lose focus of why this bill was brought. Doctors were finding that patients were not taking their specialty medicines because their out-of-pocket costs were so high. So all of these assistance programs were to help people afford their medicine. And if you take that ability away, we're going to be back where we were before this program started, and patients that are very sick and may die and cannot afford their medicine will not take their medicine because they just can't afford the out-of-pocket cost. So, thank you.
Thank you. Thank you. So we're going to close this topic out right now. Thank you so very much to our panelists who provided testimony today. We are going to move forward now to our continued discussion on the NCOIL Telemedicine Authorization and Reimbursement Model Act. We are hoping to be able to vote on this in December. We are making great progress. There's been lots and lots of discussions. Hopefully, like I said, this will be our final discussion before taking a vote in November. Today, we're going to hear about network adequacy and provider directories and how they interact with telemedicine, with an eye towards determining whether or not any provisions related to those topics should be included in the model. So if we could have, please, John Weiss from Quest Analytics, and then we're going to hear from Brendan Papard again from AHIP. So, John, please.
Great, thank you all. Good morning, and thank you for the opportunity to provide comments to the committee. I'm John Weiss. I'm the president and co-founder of Quest Analytics, and I'm here today to really provide education and discuss the importance of consistent network adequacy standards across all programs, and really share how we see how telemedicine aligns with brick and mortar for inpatient care that is essential in today's society. For a little bit of background on Quest Analytics, for those of you who may not know us well, is essentially we provide the lens into healthcare networks for both state and federal regulators, as well as the health plans, allowing them to measure, monitor, and manage their provider networks and to ensure appropriate access to care for all Americans. We're often asked to provide input to legislators to help them understand the pros and cons of policy in regard to network adequacy when changes are being discussed. We've been the innovators of this industry for the last 30 years. With introducing a passive first to the markets, we've created the vision and delivery of network adequacy into the industry. We pioneered the concept of measuring directory accuracy and the importance of trending that and transparency. And then we were the pioneers that introduced the geo-access reportings to improve transparency for Medicare, Medicaid, the marketplace, as well as the commercial plans. We're used by over 95% of America's health plans today. And when we're also the partner with both state and federal regulators to make sure that they are reviewing these plans on a consistent basis. So we're, as I said earlier, we're often called in for our expertise and industry insight in regard to network adequacy. So today, I really wanted to focus on how telemedicine and network adequacy are essentially hand in hand. As I always like to say, you know, telemedicine isn't going away. You know, the paste is out of the jar here. We've squeezed the toothpaste out and it's not going back in. But I think we need to be really consistent on how we look at this. And I think the folks at CMS have really done a very smart job of baby stepping into this process. They came out with a methodology that said telemedicine isn't a replacement for brick and mortar, it's a complement. And so what they did is they said, well, we're going to look at what specialty types can you apply a telemedicine visit, and then we're going to essentially relax the standard for network adequacy as opposed to replacing that standard. So this is what they started with. Basically, they picked about a dozen specialties and they said, we're going to allow telemedicine visits for these types of specialties. And then we're going to complement the network adequacy by reducing the percentage by 10%. Previously, they said 90% of the beneficiaries need to be within a certain time and distance. They said, if you are able to show telemedicine in that specialty, we're going to give you a credit and allow you to discount that by 10%. The other thing that we're seeing in the marketplace that is now commonplace is the requirement for a health plan to essentially notate which providers provide telemedicine services and which ones don't, to allow the consumer to have that indication and that preference of I can receive care within that provider for telemedicine, or I can receive care at that provider for brick and mortar. The other thing that I'd caution the committee to understand is that we are really kind of in the infancy when it comes to telemedicine. We're trying to understand what specialties adopt well to telemedicine and what specialties really need to have an inpatient visit. We also really don't have a tremendous amount of data because we're probably 15 months into the telemedicine, and we really need to understand, is telemedicine a cost saver or is it a cost inflator? And I think as we go further, we're going to have an understanding of how many telemedicine visits also require an inpatient brick and mortar. So therefore, my cost of care was inflated versus saved. We're going to know more in 3 years than we know today. And again, I think that, the way that we need to do this is we need to be consistent and essentially we need to baby step into this versus saying telemedicine is the future and is the only way that somebody can receive care. I think we still need to have considerations that I still need to have appropriate access to medical care. And as a consumer, I need to choose to do that either inpatient or via telemedicine. So I want to thank you for the opportunity, and if there's any questions, I'm available to answer as well.
We'll take questions after we hear from, thank you, from John, from Brendan Papard from AHIP. Brendan?
Madam Chair, thank you again. As I've previously testified, we wholeheartedly believe in investing in new ways to provide access to care. One major way is through telehealth. With telehealth, patients receive more services where they are. They have the ability to access a wider variety of providers and specialists than those who are physically practicing or maybe physically practicing in their area. This can help patients who wish to receive services from providers with particular expertise or from someone of a similar gender, race, or background to align with their unique circumstances. Though the use of telemedicine grew significantly during the COVID pandemic, we believe that it will be a regular part of some patients' care going forward. to plans for a more permanent use of telemedicine, we do urge you to consider to allow health plans to use telemedicine as an integral part of network development. I believe that network adequacy standards should reflect the healthcare delivery options available in these markets. Any standards adopted should also leave room for future innovations. For example, the NAIC's Network Access and Adequacy Model Act allows a commissioner to determine sufficiency of a network using a number of data and criteria, including healthcare service delivery system options such as telemedicine or telehealth, mobile clinics, centers of excellence, and other ways of delivering care. I will stop my comments at this point, and I'm happy to answer any questions. Thank you.
Thank you, Brendan. For the folks on Zoom, any of my legislative colleagues, if you're interested in asking any questions, please utilize the raise hand function. For legislators in the room, anyone have questions? Assembly Member Cahill.
Thank you. This is probably more in the nature of a comment, but I can precede it with a question to the folks who have some information on the subject. My experience is that the CMS network adequacy standards usually exceed most of the ones that we have in states, if states have them at all, in terms of formal network adequacy standards. The proposal here that we're considering must continue to recognize that telehealth is a supplement, not a substitute for healthcare. And so when we look at what the gentleman just presented about a 10% reduction in the standard, and I looked at the specialties, I'm not so sure that making it more difficult for somebody to do in-person OBGYN or in-person cardiac care is an advancement in healthcare. Bricks and mortar is still the way that we deliver healthcare. And until technology improves to the point where everything can be done mechanically and otherwise in a remote fashion, we still need to have those basic standards. So we usually talk about this in terms of the access of patients, but we also should be seriously considering the impact on health systems in our communities. If a health plan is able to contract with a group of providers who say, yeah, I'll cover these rural counties out in the distant areas telehealth-wise, we are probably depriving those communities of developing an adequate healthcare system in and of themselves. So I would just urge that we continue to consider network adequacy, both in terms of telehealth, but also independent of that we consider creating some models for network adequacy standards, generally speaking.
Thank you. Are there any other questions, comments from our legislative colleagues? Representative Ferguson.
I think sort of in addition to what Assemblyman Cahill is saying, I do think we have to be very careful that these insurance carriers are not steering patients to telemedicine companies that they've contracted with instead of their own physician. And their own physician with telemedicine should be the priority over a telemedicine doctor that's never seen the patient. We could actually harm rural healthcare because if you're diverting and steering all these patients to a big telemedicine company that's doctor's never even seen the patient, the local doctor's not going to be able to stay in business in that community. So, I mean, that's a real consideration for this steerage and incentivizing telehealth over your own provider.
Senator Hackett.
And I don't disagree with my people, but remember when the major problem in healthcare in this country is the cost of healthcare. One of the real abuses of healthcare is that people use the emergency room for the wrong reasons at times. And so I think one of the great things that's come out of this is the amount of telehealth that's being used to direct people to the right thing. I totally agree with my people or my cohorts that on specialties, it's real important, and I know the doctor would like to have the end, and I don't have a problem with that. But there's a lot of well-patient visits could be done through telehealth, and it's not really cutting out. I mean, they almost get the same reimbursement, not quite the same, but they almost get the same reimbursement. So you're really not, I think almost all the doctors that I see now, they're all telehealth now, et cetera. So I just think I agree with them that we shouldn't cut out specialists, and specialists need to do that. But when you go see your primary care physician, you know, he's going to order all these tests. So he's going to order the same test, you know, when you go see your primary care physician for a physical, when you go in and see him under that scenario. So I just think we're trying to be more smarter and use telehealth correctly, et cetera. And where we have the abuse is the emergency room. And it's really helped tremendously about people not going to the emergency room as they normally did for, you know, just normal colds and flu, whatever. But thank you.
Thank you, Senator. If we could have JP Weisky, please just offer a few comments on the model.
Yeah, thank you. I was the chair of the NEIC's network advocacy group that put the standards together. So it's in that context that I just want to make some comments and apologize for being a recovering regulator. So, you know, I think in context, when we looked at the issue, it was very, we had a long discussion on it, and those in the room that attended those calls, that went on for months and months and months. And the reason we added the language that Brendan talked about, I was focused on issues such as Rhinelander, Wisconsin, where literally there are no dermatologists available, right? And how are you able to get access? And we had issues inside ACA plans that would have not allowed the plans to be able, under the CMS standards, would not have allowed those plans to be able to operate in any of those counties, which would have left us bare. And we were left with a, you know, very problematic series of facts that attach, especially in a lot of rural communities. So I think that, you know, I wanted you to have that context for that discussion, because I think it is important. I appreciate the concerns around, and we discussed that around the concerns whether or not there would be a movement out of telehealth at that time. And I think the feeling was, with the lack of specialties, a lack of availability, and on top of it, even if folks are able to get to it, it is a significant drive. And there are providers offering telehealth in a unique atmosphere, where you can drive to a site and there is in fact camera capability and nurses who pull in doctors to have those discussions, and that's still technically telehealth, and it's available in those areas. So thank you. Happy to answer any questions, but thank you.
If you could, since you have brought yourself forward to make yourself available, if you might be able to respond to Representative Ferguson's question relative to networks or plans directing patients to their specific providers and not their own.
Yeah. You know, it's interesting because we talked about that as well as an issue. I mean, increasingly, you're seeing a number of companies who are getting into the insurers who are getting into the business of operating clinics, right? That is not just telehealth clinics, but are physically operating clinics. You're also seeing this as a trend, I think, in a good way for large employers who are putting clinics inside, paid for through their self-funded benefit, but administered in some cases by the insurer to get it. So it becomes a very difficult issue because there are significant access issues. On top of that, they typically are contracting with outside entities for a discount and providing one, and there's a variety of these that provide access on a national basis. So in order to be able to get the better rates, they typically do that, a national contract, so it's available 24/7, 365, instead of just, you know, in the local municipality. But I think, you know, the goal is, I think if you look at the way most of the telehealth bills are designed and the way they're sort of put together, I think the idea is to ensure some access to local providers to be able to provide that. And I agree that that's an important feature of it and provides an important access point so they can be able to it. We actually envisioned in Wisconsin, when I was there in the department, that there are some possibilities that if you design this correctly in your state, that it could be a differentiator and start attracting. If you have a good environment for doctors, and in Wisconsin we had a good medical malpractice, that you might actually be able to use this, use telehealth as a way to bring in more medical care in specific areas, and for the rural communities to be able to have broader access to attract providers who have a better quality of life there and are able to practice telehealth as well. So I think it's a complicated issue. So thank you.
Thank you. Any other questions? Comments? Okay, we are going to take all this into consideration and get to voting on this, hopefully at our December meeting. So if I could please have Daniel Schwartz, Charlotte Taylor, and Chris Brady, please, if they're here. Okay, come forward to sit at the panel. We're going to have Chris Brady go first. This is a discussion on our NCOIL Model Act regarding air ambulance. I have to say, having been health chair for a couple years, this model has been a point of conversation and has changed along the way since it's been introduced. We've had an introduction, we've had an amendment, we've had federal legislation, we've had state legislation, we've had lawsuits, so it's kind of like a soap opera a little bit. So we want to make sure we get as much information as we possibly can. If you recall, a great discussion we had in our last meeting in April. Towards the end of the meeting, we made a decision that we need to further examine the legal issues surrounding this type of legislation. So today, we have legal experts who are closely involved with the litigation surrounding this type of legislation, and they can help us clarify a few things. We'll take questions at the end of each one of their comments. Much of the conversation will focus on the 8th Circuit Court of Appeals opinion. If you have your binders, it's on page 367. Also before you is an analysis of that opinion provided by one of our speakers, which is with us here today. Before we start the discussion, the list of sponsors of the model has grown since our last meeting, which now includes Illinois Representative Thaddeus Jones, joining Kentucky Representative Deanna Frazier, Texas Representative Tom Oliverson, and West Virginia Delegate Steve Westfall, who is here with us today. So in this order, we will hear from Chris Brady of Air Methods, Charlotte Taylor of Jones Day, and Professor Dan Schwartz. Okay, very good. Okay, Mr. Brady.
Thank you. Chair Hunter, Vice Chair Ferguson, members of the committee. My name is Chris Brady. I'm the Senior Vice President and General Counsel for Air Methods Corporation, and I thank you for the opportunity to discuss state's ability to regulate air ambulance memberships under the McCarran-Ferguson Act today. At the outset, I believe it's important to affirm that Air Methods agrees with the other air ambulance providers that only laws regulating the business of insurance can avoid the preemptive scope of the Airline Deregulation Act. Where we continue to disagree, however, is whether an air ambulance membership product that pools consumer risk qualifies as a business of insurance such that they would be subject to state regulation under McCarran-Ferguson. Air Methods is aware of the West Virginia District Court's recent decision in Dodrell and its earlier progeny, including the 8th Circuit decision. I won't waste this committee's time with a line-by-line analysis of where we think the court got it wrong, but simply note that we fundamentally disagree with the court's conclusion. Dodrell and its progeny are, however, instructive in the tests that courts look to determine whether McCarran-Ferguson preemption applies. There's 3 elements to this test. Does the practice in question have the effect of transferring or spreading policyholder risk? Is the practice an integral part of the policy relationship between the insured and the insurer? And is the practice limited to entities within the insurance industry? What I would say is at this point, there really can be no debate about the first point. Every court that's looked at this has agreed that there is sharing of risk between the issuer and the buyer. Membership programs operate exactly like an insurance pool, with providers pooling risk that exceeds the value of the membership plan. On the second question, whether the practice is an integral part of the policy relationship between the insured and the insurer, and the third question, is the practice limited to entities within the insurance space? What we've seen is very light analysis from the courts on this, and some engagement in semantics and whether a contract is a policy or whether a policy has to expressly be called a policy to qualify. From our perspective, that is a largely academic pursuit. I won't dive deep into that. What I would do, however, is point you to Professor Schwartz's memo. He discusses this test in great detail, and remarkably, he comes to the same conclusion as Air Methods in regards to this 3-factor test. On page 10, he states that the 3-factor test does suggest that air ambulance memberships constitute the business of insurance. Now, to be fair, Professor Schwartz offers further explanation, suggesting that courts should be using a different test to look at this. This is a test that no court that has looked at this has applied, but again, to be fair, he suggests that McCarran-Ferguson would not apply and that states will continue to face legal headwinds. However, this analysis is turning on whether the membership issuer rates or underwrites these products or just uses them to pro-offer medical services. From Air Method's perspective, this is akin to letting the fox run the hen house. Whether or not providers rate or underwrite their products should not and cannot be the definitive determination as to whether these products are insurance products. Air Methods, it really remains cognizant that the underlying driver of these discussions started out as consumer protection discussions. Membership products are marketed and sold as insurance products. Consumers commonly identify them as such, and they treat them like other health insurance products, even delaying care to ensure they are transported by a covered provider. Air Methods records indicate that over 200 patients have delayed care to wait for a covered air ambulance membership provider rather than take the closest, most appropriate provider for emergent care. Further, just this year, a Medicare patient in California refused transport with Air Methods to wait for their air medical membership provider. The air medical membership provider was not available for several hours, and that patient died in the hospital before they could be transported, even though there was other providers available, ready, and willing to transport. This is a tragedy, it's egregious, and it's a direct result of consumers being marketed these products on the basis of fear and insurance. Yet providers continue to suggest that the McCarran-Ferguson Act gives the states no ability to regulate these products. The federal government has entrusted states to protect consumers in the insurance realm and reaffirmed that commitment through the MFA. Air Methods remains committed to finding a solution to prevent these tragedies from occurring and is committed to working with this body to navigate these legal challenges.
Actually, thank you very much, Chris. We're going to go to Professor Schwartz first. Thank you. And then we'll hear from Charlotte.
Thank you very much. So I want to start off just by explaining my role here because it's a little bit different. I was hired to be an independent consultant. I'm a law professor, and to provide my legal analysis of this opinion. And so everything I'm about to tell you is my independent judgment, and I was hired to provide that. And my independent judgment is that actually this is a very clear legal issue, and that states don't have the authority to regulate air ambulance subscriptions as insurance under the McCarran-Ferguson Act. And so to explain that, I just want to first make sure we're all clear on the framing and then go through my analysis and respond to some of the characterizations of my report, which have been given to you. But you'll see my report, which is quite lengthy, and I apologize for that. It was very much mischaracterized by the prior speaker. I very much come to the conclusion, both that states do not have this authority, and states don't have this authority either under the Pareto test or any other test. Okay, so with that in mind, I think it sounds like we can all start from the assumption that if air ambulance subscriptions constitute the business of insurance under the McCarran-Ferguson Act, then states have the authority to regulate them. But if they do not constitute the business of insurance under the McCarran-Ferguson Act, then in fact there's ADA preemption. So the first really important framing point to understand here is that this is actually not a question of state law. And whether or not you want to define air ambulance subscriptions as the business of insurance under state law is actually not pertinent to the legal analysis, because the legal analysis turns on the meaning of the phrase, the business of insurance, in the McCarran-Ferguson Act, which is a federal statute. And as you no doubt are aware, state law can't supply a definition to a federal statutory term. So what that means is we have to answer this analysis and conduct this analysis looking to federal precedent regarding the meaning of this federal statutory language. And my report details that I actually think that the federal precedent is absolutely clear and US Supreme Court precedent is absolutely clear that air ambulance subscriptions are not the business of insurance, and hence that states don't have the authority to regulate them. This decision, this judgment, of course, is consistent both with the judgment of the Eighth Circuit and now with the West Virginia District Court. Now, let me explain why I reached this conclusion. If you look at Supreme Court precedent, it is true that the Pareto test is out there and it's relevant and it's important and you can conduct the analysis under Pareto. But there are a number of factors that, in my view, make it absolutely clear, even without clouding ourselves with Pareto, that air ambulance subscriptions are not engaged in or do not constitute the business of insurance. The US Supreme Court has been absolutely clear that the business of insurance involves, you're not going to be surprised to hear this, underwriting and rating risk, right? Charging different prices to different people depending on the amount of risk that they pose, and potentially not offering insurance to unduly risky individual applicants. That's not what air ambulance subscriptions do. They're offered to all comers on a fixed fee. Moreover, US Supreme Court precedent, including US versus the Royal Drug case, makes it absolutely clear that in assessing whether or not a product is insurance, one has to look at whether or not the product is being offered for the principal purpose of risk transfer or merely to facilitate the provision of services. In fact, the US Supreme Court says in the Royal Drug opinion that prepaid medical services are not considered the business of insurance under the McCarran-Ferguson Act, because that's not how Congress understood that language when it enacted the McCarran-Ferguson Act in 1945. Well, if you look at air ambulance subscriptions, why are they offered by companies like GMR? They offered not because GMR is interested in becoming a larger insurer and transferring risk. They're offered to facilitate their provision of a service, air ambulances. That's what GMR does. They provide air ambulance services as well as air methods, okay? They are not focused on the business of spreading or transferring risk. They're just using that in an instance to help facilitate their provision of services. And this is actually very much analogous to a case that the US Supreme Court discusses at length in its Royal Drug opinion, which is discussed in my lengthy report. Third, air ambulance subscriptions don't actually require payments to anyone. They don't require payments to third parties. They don't require payments to consumers. All they specify is that any amount that's owed will be canceled and won't be charged against the consumer. So courts have been very clear that such debt cancellation contracts don't constitute the business of insurance. Why? Well, the business of insurance usually involves you sell a product and you have to enter in a reserve, right? You'd say, well, we anticipate this is how much we're going to have to pay in the future. You then have to invest in assets to match those reserves. None of that happens with debt cancellation contracts like those at issue here. There's no reserving. There's no investing in assets to match those reserves. And again, different US Supreme Court precedent on the same point makes clear that in general, insurance involves insurers taking on investment risk. Now, I want to discuss specifically Pareto because talk about out of context quoting of a report. The quote you heard, and I'll just first repeat what was said because it really, shockingly mischaracterizes what I say. I on the bottom of the page say, there is a quote that says, the Pareto test does indeed suggest that the sale of air ambulance subscriptions constitutes the business of insurance. What was left off? The start of the sentence. If one assumes this to be the case, what are we assuming? If one assumes that the sale of air ambulance subscriptions constitutes the business of insurance, then the Pareto test is satisfied. So what I'm trying to establish here is that, in my view, part of the reason why courts have had some difficulty with the Pareto test is it's actually not a perfect fit for these circumstances. It's certainly true that courts have applied the Pareto test, and we can both apply the Pareto test and, as my counterpart described it, sort of use different semantics. But it ends up becoming a semantic game of, are we going to call the sale of air ambulances subscriptions insurance? Are we going to call those people who buy it policyholders? If we do, the Pareto test comes out one way. If we say, no, it's not insurance, and they're not policyholders, the test comes out another way. And so in my mind, the real reason why some people get a little bit confused about this is because they're not focusing on the right question, which is, are air ambulance subscriptions insurance products? And once you focus on that question, the Pareto test actually becomes very simple. And I actually walk through the proper application of the Pareto test on the top of page 11 of my opinion, where I say, if one starts from the premise that the air ambulance companies that sell subscriptions are not insurers, then the Pareto test yields the opposite result. And of course, my entire report is about why that is the proper starting assumption. So in my mind, and again, I want to emphasize, I don't really have a bone to pick in this. I mean, and frequently I'm hired and to look at an issue and I come back and I say, it's not the answer you want. In this case, I was hired, and the more I looked into this, just as an independent academic who has been working with the McCarran-Ferguson Act and working with insurance matters for several decades, the more I became convinced that there is not a question here in my mind in terms of whether or not these laws are going to be upheld. Efforts by states to regulate air ambulance subscriptions as insurance will continue to be struck down by federal courts. It's not a fluke that you have the Eighth Circuit and the West Virginia District Court striking down these laws, and they're going to continue to do so. So my advice to you is simply that's going to continue to happen, and efforts to avoid that are not going to be successful. That is my conclusion, and I'm happy to answer any questions you may have about it.
Thank you. We're going to go to Charlotte Taylor. Just quickly, though, Professor, you made mention several times that you were hired. Can you make mention of who hired you?
Absolutely. I was hired on behalf of GMR.
Thank you. Ms. Taylor, please.
Thank you. Thanks for the opportunity to talk today. I just wanted to return, Chair Hunter, you noted that this has been a soap opera, and that seems true to me as well. And I think a big question is, what is going to be a productive use of the resources of state insurance legislators going forward? And I agree with Professor Schwartz that trying to regulate air ambulance memberships as insurance is not going to be a productive avenue. It's going to be a dead end. I will touch on some of the similar issues, but hopefully not be too repetitive. I just wanted to start by reviewing how we got to this place, which is, it all starts with the Airline Deregulation Act. This may be familiar to some of you, but the Airline Deregulation Act is a federal statute that gives exclusive regulatory authority over air carriers to the federal government when it comes to air carrier rates, routes, and services. So any state law that regulates the rates, routes, or services of an air carrier is going to be preempted by the Airline Deregulation Act. Air ambulance providers are federally regulated air carriers. All of GMR's providers have certificates with the Federal Aviation Administration and the Department of Transportation. And memberships are effectively a way of paying for the services of an air carrier. It's a way of saying, the consumer says, in advance, I'll pay this small fee, and then if I'm transported, that's going to be, my entire out-of-pocket cost. The air carrier will recover from the insurer as applicable, but that's all that the consumer will be charged. And over the years, the Supreme Court has looked at, for example, frequent flyer programs offered by, airlines, and said those are ways of effectively paying at a discount for air carrier services, and so state efforts to regulate those are preempted. And numerous courts have looked at the GMR membership in particular and come to a similar conclusion. This is a way of paying for a portion of the fare, essentially, when a patient is transported, and therefore ADA preemption applies to state laws that try to regulate that. We saw the Fourth Circuit come to that conclusion in Cheatham. We saw Guardian Flight. The Eighth Circuit opinion has that portion of its analysis, and the two West Virginia courts that have recently addressed this have also looked at this specific membership and found that preemption applies. So that's the baseline. And then the question that has come up over and over is whether the McCarran-Ferguson Act offers a kind of key that's going to unlock this. And Air Method's position has been that it does, but that is just not what the law says under the McCarran-Ferguson Act. And it, there's not going to be another way to, spin this around to change that conclusion. So Professor Schwartz already spoke about McCarran-Ferguson Act reverse preemption. I don't want to repeat too much of what he said, but essentially it's a federal statute that saves state laws from federal preemption, for example, by the Airline Deregulation Act, if they're regulating the business of insurance. And the two key points to me, again, repeating what Professor Schwartz said, is first, that phrase, the business of insurance, is a federal statutory phrase. So there are instances where many states will regulate a product and that they consider to be insurance, but for federal law purposes, it's not the business of insurance. And I go back to a 1959 Supreme Court case, SEC versus Variable Annuity Life Insurance Company of America, that talked about variable annuity contracts. And many states regulate those as insurance, but the Supreme Court said for federal law purposes, this is not the business of insurance under the McCarran-Ferguson Act because there's no investment risk-taking on the part of the companies offering those products. So state changes to state law or categorizations that you can make under state law aren't going to alter the analysis that the Eighth Circuit, for example, the conclusion that it came to. And the second point that I think I would emphasize is that going back to the Royal Drug case, which Professor Schwartz talked about, case after case has held that debt cancellation contracts or prepaid discounted services contracts are not the business of insurance. Now, many of these are now in the air ambulance membership area, but it's not limited to that. So the Royal Drug case looked at a prepaid medical services plan called the Group Health Plan, and that had been discussed in the Jordan case that Professor Schwartz mentioned, and said this is not the business of insurance because the purpose of this arrangement is not to pool risk and use actuarial analysis to calculate what reserves are necessary, et cetera. The purpose of this is to get people health insurance, health services. And so building on that foundation, and there's been a dispute about the Pareto factors, and we think that those do not point in the direction of this being the business of insurance, but also just taking a step back, you have the Royal Drug case that says prepaid medical services plans are not the business of insurance. Then in 1990, there's a case called First National Bank of Eastern Arkansas versus Taylor. The Eighth Circuit said a debt cancellation contract is not the business of insurance. You have an 11th Circuit case from 2014 called FTC versus IAB Marketing Associates. That was a case where someone was offering a membership plan that gave you discounts on medical services. The 11th Circuit said this is not the business of insurance under the McCarran-Ferguson Act. Then you have the Guardian Flight decision coming to that specific conclusion with respect to the GMR membership. And you have the two different judges in the Southern District of West Virginia also coming to that conclusion. And what we've seen in the air ambulance space specifically is that it doesn't matter how different state laws have tried to get to the same, to trigger MFA reverse preemption, it all comes to the same place. So North Dakota had enacted a complete ban on the sale of air ambulance subscription plans, and the Eighth Circuit found that that was preempted and invalid. Wyoming had passed a law saying that air ambulance membership plans count as disability insurance. After Guardian flight came down, the Wyoming folks recognized that that was not going to be a viable path forward, and GMR worked with them on an alternative solution. West Virginia, the first West Virginia case, the insurance commissioner had proposed to apply the general definition of insurance and say, I'm going to define memberships as insurance. That was enjoined. That's subject to a preliminary injunction. And then in the second West Virginia case, the legislature passed almost the exact bill that Air Methods has been advocating for. And again, Judge Johnston, Chief Judge Johnston there found that that's not the business of insurance. And as he said, calling the sky green does not make it green. Calling something insurance does not make it insurance for the purposes of the McCarran-Ferguson Act. I'll stop there and leave time for questions, but I think that, the answer is, this is just not going to be the magic key that unlocks this. The law is very clear. There's numerous precedents in this area. And it's not going to be a productive use of legislators' time to have another try with a different version of this.
Thank you. I think as legislators, I know, as one, it is always our responsibility to make sure anything that we are promoting and putting forward has the best interest of our constituencies. Our constituencies are our friends and neighbors, folks in the community, and/or organizations in the community. And we've been talking about this for many, many months and wanting to make sure that the best possible model product that we can produce obviously is put forward. That way, regardless if it's a blue, purple, red state, that it's a foundation that we could put forward. So just leading us in that direction with respectful conversation, I want to now open it up for our legislative colleagues who would like to ask questions. We have a list. If you're on Zoom, if you could please raise your hand. We will start with Delegate Westfall, please.
Get this to work. Yeah. Thank you, Madam Chair. Question any of the three people today, but thank you. But with all the states you name trying to do something to regulate this industry, there's got to be a problem. I think there's a problem in West Virginia is why we passed the law we did, which the courts didn't agree. My question is, read it here. Is your position that state can or cannot protect customers or consumers from bad actors without preempting the Airline Deregulation Act? Is there any way we can do it without doing that? We're trying to protect our people. So what do you suggest?
So GMR has advanced a model bill that works, that has consumer protections in it, and with an emphasis on transparency, disclosures in advance, and opening up avenues for consumers to lodge complaints and to see those addressed. And in a state like Wyoming, GMR worked with the legislature to come up with a solution like that was mutually acceptable. I would also say that the Department of Transportation is another place where consumers have recourse, and that's very clear in the Airline Deregulation Act, that the Secretary of Transportation can enjoin any unfair practices. So it's not the case that GMR is saying, we want to absolutely escape any consumer protections, but it has to be something that's navigated consistent with the applicable law.
So what I would say is, I want to stick to my role here. My role is to help you understand what things you can do that will actually survive, that will actually be effective. It's probably the least effective way you can help consumers is by passing a bill that several years later is going to get struck down by courts, and then you've not done anything. You've created uncertainty. So that's my only goal. It's in that vein that I offer my advice, just from a legal perspective, that attempting to do what you want to do by declaring that air ambulance subscriptions constitute the business of insurance will not work. That is not an effective strategy. I have a lot of ideas about what might be effective strategies, but I'm not an expert in that arena, and I don't want to pretend that I am. Where I am an expert is on insurance law, and it's in that spirit that I offer you that advice, which is attempting to solve this problem through a solution that will be struck down by courts is probably not the best use of your resources and time, and I'd encourage you to find a different alternative solution among the options that are being discussed.
I have one more question. New York and Florida have passed legislation trying to regulate air ambulance bills. GMR has not challenged those. They did challenge what we passed in West Virginia. Do you think what they did is okay? I mean, why does not challenge Florida and New York's?
I can't speak to all the details of that, but I will say that, GMR has made a concerted effort to work on a state-by-state basis with with legislators and the insurance departments and figure out how are we going to be in the state. And in a couple of instances, a decision was made simply not to offer the membership to residents of the state. In West Virginia, there are a number of, the membership has been there. There are many members who rely on it, and that was in place before the law was passed.
Okay. Madam Chair, if I may say that I think we need to continue to look at this, maybe a different route, maybe the same route. Like I said, what we passed in West Virginia was struck down by the Supreme Court, but I still think it's a problem or we wouldn't be talking about it. So thank you, Madam Chair.
Thank you, Delegate Westfall. And I guess in follow-up to that sense, we do have a model on, the table that's introduced. I'd like to ask, actually, Mr. Brady, just from some general comments and response. We obviously have heard from some of the folks here, that are a little bit different, and in concert with what Delegate Westfall said, he did pass legislation in his state. We've passed legislation in the state of New York relative to this. So just wanted to get a little bit more clarity. Obviously, folks sitting here today have very different views on what's being proposed. So if you would kindly make some response.
Yes, ma'am. Thank you for the opportunity. I think looking at Florida and New York as guides is important. I think there's not clarity from us, and it doesn't sound like there's clarity for this committee as to why those laws are okay and others are not. I think even in West Virginia or in Wyoming, providers have worked with states. And I think as we think about how to take care of consumers and work with this body, it's a difficult path for us to navigate. We're committed to doing that. I think we'll continue to look at states like New York and Florida that have not taken challenge to their laws as instructive. And we'll go back because, from what we can tell, it does not seem to be an issue with other air ambulance providers.
And just one last question before we go to Representative Frazier on Zoom. I had asked many months ago, and I don't know if I had ever received a response. With all of these questions and going back to the consumer and our state's, lead law enforcement agent with the attorneys generals across the country, have there been any consumer protection lawsuits from the attorneys general relative to, subscribers or consumers coming forward saying, I've been duped, I bought something, this isn't what it was purported to be? I don't know, and I don't know if I've ever received an answer to that question.
Yes, ma'am. I can speak for our methods. We're aware of at least 3 class actions that were brought by consumers. They weren't brought by state AGs, but they were brought by consumers on behalf of consumers who purchased these membership products and then were subsequently billed after the transport for out-of-pocket costs or from proceeds from other insurance policies, related to a tragic accident or some type of larger medical emergency. I think the public record on those speaks for themselves, but I believe the providers of those memberships have relied on the Airline Deregulation Act to suggest that there is absolutely no recourse for those consumers.
But those are personal lawsuits brought not from a state relative to an organization.
Yes, ma'am. I'm not aware of any states that have brought these through an attorney general's office.
Okay, thank you. We are going to Representative Frazier, followed by Representative McCoy.
Thank you, Madam Chair. I have two quick questions. The first is for the Attorney Taylor. With the new federal No Surprise Billing Act preventing air ambulance from balance billing, it would appear that the only benefit the company's membership product would provide to customers is covering cost sharing amounts that are determined by third parties. Do you have a comment in regards to that?
I'm sorry, I had a little trouble hearing the question.
Thank you. It's in regards to the federal No Surprise Billing Act. When that goes into effect, it's essentially going to prevent air ambulance from balance billing. And it would appear that the only benefit your company's membership product would provide to customers is covering the cost sharing amounts that are determined by third parties.
So once the No Surprises Act is effective, that's right, for patients with private commercial insurance, there will not be balance bills would not be sent to the patient after that. But that, first of all, is it's a limited category of patients. And copays and deductibles are really substantial expenses. We heard some testimony earlier today about plans with a $4,879 deductible. There's also a 20% copay amount for all Medicare transports, and that's a huge portion of the market. So the idea that patients will not have really significant out-of-pocket expenses after No Surprises is law, I think is not accurate.
Okay, thank you. I have a follow-up, and it's on a little different topic, but I've been aware that recently a trauma patient in California insisted on waiting for their free air ambulance to arrive while other air transportation was readily available. And tragically, that person ended up dying while waiting for their membership helicopter to arrive. Do you have knowledge of other cases where this might have happened?
I do not have knowledge of any cases where that has happened. Mr. Brady made some representations about that case. I don't know what it was. I do know that the GMR membership terms and conditions state very clearly that members should, in a health emergency, take the first available transport. And they make it clear that the GMR provider is not always going to be available to be the first called.
Okay. Thank you, Madam Chair.
Thank you. Representative McCoy, please.
Thank you, Madam Chair. So my question is this, and maybe to the professor. You know, the comment in the West Virginia case that you can't just call something green really does bring up, I think, a states' rights federalism sort of issue. And looking at the GMR Model Act that I heard you say you have proposed, how is it going to withstand constitutional scrutiny? What's the legal analysis behind that that gets us around the preemption?
So what I would say is this. It is true that in that opinion, and I think accurately in that opinion, what is stated is that states can't supply a definition of a federal statutory term. And so states do have the authority to define the business of insurance for a variety of purposes. But in this unique circumstance, the issue turns on the interaction of several statutes. So I think that's the first point. Now, I understand your question. Your question goes to whether or not there would be preemption under the Airline Deregulation Act of the alternative models. And on that point, I think the question really is, you don't get to a legal question if you have a political settlement. So if everyone is satisfied with that language. It may not even get to that. I will say I have not analyzed, and so I don't want to speak to the preemption analysis. The preemption analysis under the ADA asks about state regulation of rates and services. And so that would be the question, whether or not the regulations that are more oriented toward transparency constitute that. And I think there can be arguments on that wouldn't turn on the definition of the business of insurance. And again, I want to stay in my lane because I only want to offer you opinions about where I'm very confident and consistent with my expertise. And where I'm very confident is attempting to get around the Airline Deregulation Act through the mechanism of labeling this insurance will not work. Obviously, if you have a compromise settlement of some type, or if you have an understanding that transparency-oriented measures are not going to be challenged under the ADA, you might justify that by saying it does not constitute a attempt to regulate rates or services. Whereas it's very clear, many courts have held this, that attempting to regulate subscriptions directly constitutes a regulation of airline rates. And so I think that's why the issue is different. And I think that would be, the domain in which you can reach that type of negotiated settlement.
Thank you. But it sounds like, though, that's almost we just agree we won't sue you, but if we did, we would win. And that if we're making bad policy, that still sounds like bad policy to me. Thank you, Madam Chair.
Thank you, Representative McCoy. We have two other questions. We have come up to our time, so we want to be sensitive to the executive committee that needs to be meeting. So we are going to hear from Assemblymember Cooley, then to close Representative Oliverson. Ken, please.
Thank you, Madam Chair, and I'll be quick. In California, we've looked at some of these. Obviously, there is a very important state interest to the extent that state dollars fund medical care that costs not be outrageous. There is a clear consumer interest to have people know what's going on. I think at the state level, the state interest in protecting the public risk and the consumer interest in being protected are important values the state can bring to the table, even under the ADA. And I think that becomes part of how you can start to approach it and make the argument that this is fit for state regulation. I do note that just a month ago today, the leadership of the NAIC sent a letter to the Department of Transportation, which has established a air ambulance and patient billing advisory committee under the 2018 Reauthorization Act for the ADA, and that basically asked the DOT to look at how you might give states jurisdiction on some of these consumer protection issues, specifically with respect to air ambulance. So I think for us as lawmakers, it's going to be very important to take note of the NAIC's approach to kind of reach out to the federal government and build the case for some tweak to the relevant law. So I think that this is a very large and animated conversation on many fronts at this moment, including, of course, here at NCOIL. So not really a question, but a take on the issue, Madam Chair.
Thank you very much. Representative Oliverson.
Thank you, Madam Chair. I appreciate the opportunity to be with you virtually. I just wanted to correct the record from our previous meeting because it turns out that I had spoken with regards to a particular company that I became aware of as we were advancing legislation in Texas, which is similar to the GMR proposed model. There was some conversation in committee. There was a company, I spoke about it in our last meeting, HeliMedic, which is a supposed subscription service. And I think I expressed to the committee that in fact, some of the facts and details about this company were not correct. But I just wanted to clarify that, in fact, upon further investigation, my office has been unable to reach anybody in this company The airport where supposedly they're going to have air ambulances has no record of them ever being at the airport or any request. And our Secretary of State has no record of this company incorporating in Texas to do business. So it very much seems like a fire festival type operation. I feel very misled and I'm very disappointed. And I just have to say, as I've listened to this conversation, with all due respect to the professor, I'm encouraged by what I've heard with respect to NAIC, and it may be worth our efforts as well at NCOIL, since I do believe this is an ongoing consumer issue, for us to join them in their efforts in asking the Department of Transportation to clarify with respect to the ADA this very important issue. My understanding is that this is one of the largest Medigap products that consumers do purchase, even though they may already have coverage or do have coverage through Medicare, that this product is sold widely to Medicare beneficiaries. And yet it is supposedly completely beyond our reach, despite numerous consumer complaints that we receive across our state. So I really commend Delegate Westfall for staying the course. I'm sad to report that in Texas, our efforts at compromise legislation were not very well supported and went absolutely nowhere. And I would encourage us to continue to work aggressively on this issue at the state and federal level. Thank you, Madam Chair.
Thank you, Representative Ollerson. We are going to conclude this panel. We will work with Delegate Westfall as we move forward to our annual meeting in December to try to get to November, excuse me, to get to some kind of conclusion. For anyone who has any other comments, questions, concerns, if you could address those, send those along to Will. We'll make sure that we address them accordingly. Thank you to our speakers today. We have one last piece of business. I need a motion to readopt the NCOIL Employment-Sponsored Group Disability Income Protection Model Act, which we originally adopted in November 2016, and we temporarily readopted that in April. So moved.
A second.
Second, all in favor?
Aye.
Opposed? Thank you very much. If I can get a motion to adjourn, please.
Move we adjourn.
Second, all in favor? Meeting adjourned.
All right. We'll go ahead and get started. Call the meeting to order. Will, if you want to call the roll. All right, let's do this. There's a bunch of people and there's not as many here. So we're going to do this. I'll just go through identification. If you're on Zoom on the executive committee, identify yourselves. We'll turn to Zoom first.
Assembly Member Ken Cooley, present.
Senator Ronnie Cromer, South Carolina.
Representative Edmund Jordan, Louisiana.
Is that everybody on Zoom? All right, we'll go around the room here and we'll start with you, Senator Udke.
Senator Paul Udke, Minnesota.
Representative Bart Rowland, Kentucky.
Representative Joe Fisher, Kentucky.
Senator Bob Hackett, Ohio.
Representative Ferguson, Arkansas.
All right, I'll need a motion to waive the quorum requirement. Is there a second? All in favor, say aye.
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 I also need a motion to adopt the minutes from our April meeting. Is there a motion second?
Second.
All in favor, say aye.
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 All right, an update on future meetings. Am I doing that, Tom? Or- I can just tell you right now, our meeting in Scottsdale, Arizona is going to be in November. Looking forward to that. I tell you, I got to be honest with you, a lot of people who left already, I loved what they said, and that was, see you in Scottsdale. So I think we're going to have a good turnout. I like the idea that we're moving towards a full in-person, back to normal meeting, and looking forward to that. And we'll continue to use Zoom in the interim as it is a useful tool for those types of meetings. Our other meetings in 22, you can see we've got Vegas, Jersey City, Vegas in the spring, Jersey City the summer, New Orleans, our annual meeting. Good locations, should have good turnout. And obviously with what we talked about this past couple of days, obviously very good topics as well. And then our 2025 annual meeting, I think this was done so we were assured we were getting our November dates, and that is in Atlanta, Georgia. And that will be in November of 2025. Any questions on any of the updated and future meetings? All right, Tom, I'll turn it over to you for the administration for our meeting report and financials.
Thank you, Mr. Chairman. This meeting, we're stoked to say that we have 340 attendees, one means or another, 268 in person, which is a really solid number, 72 virtual. We had 66 legislators here from 29 different states, 57 in-person legislators, 9 virtual, 28 first-time legislators. We had 4 participating commissioners, a total of 10 insurance departments were represented as well. And do you want to take the mic back to tell me to do the financials, or you just want me to roll? The unaudited financials through March 31st, March 3rd. Now, I think these are through June 30th. Show revenue of $783,000 and expenses of $501,000 for an excess of revenue over expenses of $282,000 heading into this meeting.
All right, thank you, Tom. I'll turn it over to Assemblyman Ken Cooley for a report from our audit committee.
Yes, on Wednesday of this week, we received the audits from our auditor, Collins and Company, and audit for both the National Council of Insurance Legislators financial statement and then the Insurance Legislators Foundation financial statement. In each case, the audits were unqualified, no items of note. With respect to focusing first on NCOIL, our statement of financial position, our balance sheet showed us with a 2020 balance, total liabilities, net assets of $1,071,206. And that was a gain over 2019, which was $679,000. We show net income in 2020 for NCOIL of $351,337. That's again net income through calendar year 2020, gain 351,337. That compared with a similar period in 2019 of 95,115. So we are in a strikingly strong financial position. So when you look at the statement of cash flows, our net increase in cash and equivalents over 2020, our net increase 386,823. So that was the most striking. We just had a very outstanding 2020, notwithstanding COVID. And that was even remarked upon by our auditor. It was noted that we had our funds in banks that exceeded the 250,000 federally insured level. And that was a note to the balance sheet. And we adjusted that by transferring $350,000 to a third bank to address that excess of funds in a single bank relative to federal insurance. With respect to the Insurance Legislators Foundation, similarly, as I say, an unqualified audit, a much smaller dollar amounts presented there, but everything was in order. No alarms raised. It was stated by our auditor that they found that in examining the books and records of NCOIL and in asking questions of staff and officers, that information was readily available. And so the counsel to NCOIL was we need to continue our strong adherence to safe financial practice, which was noted as including as specifically our president's practice of keeping all officers informed on significant financial transactions as a matter of routine. And that was commended as a excellent organizational practice. So that is the overview. Are there questions? We need to start with questions, and then there's a need for adoption. Receipt of the report.
Are there any questions for Assemblyman Cooley? Hearing and seeing none, is there a motion to approve the audit? Second. All in favor, say aye.
Aye.
Opposed? Thank you, Ken.
Thank you very much, Mr. President.
Next item I have here is our special committee on race and insurance underwriting. We had our fifth and now final meeting of that committee as it sunsets pursuant to our bylaws. It, I think, has done a good job. It met its charges. We came up with 3 resolutions out of that committee. Those can be found on our website, but they're also, I think, in your book. A resolution using certain rating factors, a resolution regarding the use of artificial intelligence, and a resolution regarding insurance score transparency. I will say this, the work on all these issues, much broader than that committee, will keep our 11 committees busy as these issues come up. They will be assigned to the proper committees moving forward. The next item I have is on our consent calendar. As you know, we have a consent calendar where we take committee.
Those resolutions, since they're not on the consent calendar, need to be approved here.
Okay, that's true. Since the resolutions that were adopted by that committee are not on the consent calendar, I'll need a motion to approve those 3 resolutions.
I move adoption.
By Kevin, second by Assemblyman Cooley. All in favor, say aye. Opposed?
Aye.
Okay, now to our consent calendars, you know, our committee reports, including resolutions and model laws that are adopted or readopted, as well as the decisions that were made and actions taken by NCOIL officers in the interim times between executive committee meetings are part of this consent calendar. I'd ask now if there's any committee members that would like an item removed from the consent calendar. If not, we'll move them as a block. Those issues are the work comp committee readopted 3 of our models. The property and casualty committee adopted 1. And then just recently, the last meeting here, the health committee had readopted a model as well. So I think you see those there. Are there any questions on those? If not, I would take a motion to approve the consent calendar.
So moved.
Is there a second?
Second.
All in favor will say aye.
Aye.
The other sessions that we had, we were very honored to have our keynote speaker be Governor Charlie Baker in Massachusetts. I thought he did a great job, including taking questions when his staff said not to. I liked that. And I liked the fact that he was very supportive of state regulation and also the lower part of government, which is very good. The Griffith Institute back for their lunch in person again, which I think was really great. Unfortunately, I was elsewhere at a meeting, but I heard that it was a good session on the surplus lines. I want to thank you to Dr. Brad Carl for his presentation there. We also had, I think, 3 very interesting and timely general session meetings, development of the medical treatment for obesity, delicate balance of legislative oversight, which is very timely with what's going on now in our states with COVID legislation, et cetera. And then finally, the one on cyber insurance this morning, which I thought was excellent. And again, just I think the tip of the iceberg in a way is this will continue to be an issue that we'll deal with, especially with challenges of ransomware, et cetera. Also want to just comment, again, thank you to our NEIC commissioners that were here. We had a good meeting with them, and it's always good to work with our partners on the regulatory side. We have some other business to deal with. We have new executive committee members, As you know, our bylaws say that if you are the chair of the state committee with jurisdiction over insurance, you are therefore automatically an NCOIL executive committee member if you're present. And those that are eligible would be Connecticut Representative Kerry Wood, who chairs the Insurance and Real Estate Committee, Delaware Senator Spiros Montavinos, which chairs the Banking, Business, and Insurance, Mississippi Representative Henry Zuber, who chairs the Insurance Committee, and Wisconsin Senator Mary Felkowski, who chairs the Insurance Licensing and Forestry Committee. So they are now part of our executive committee. Oh, they're not, I mean, sorry, and they're not here on Zoom. So they're the ones that are eligible to be on the executive committee when they're present. IEC, I'll turn to, is Russ Harper in the room? Russ, do you want to give us a report on IEC's recommendations of topics, general session topics? Okay, Teresa?
I realize you may not, this is a not very crowded room, so you maybe don't need the mic, but my name is Teresa Casey. I'm administrator of the Industry Education Council, and we have two topics that we think are pretty timely for consideration for the NCOIL annual meeting agenda. They both reflect subjects that we've heard quite a bit about in the last few days. One of them picks up on the race and insurance issue, specifically addressing diversity in the insurance industry. Our member Adam Kearns of Zurich, North America, has presented some success that Zurich has had on recruiting from underserved communities. They have put 118 people into jobs at Zurich, paid for training, paid for people while they're in school. And we see this as potentially scalable to the industry and possibly even of use in public sector settings. Relatedly, on long-term care insurance, the National Association of Insurance and Financial Advisors thinks that the time is right to consider collaborative, innovative solutions, particularly as Washington has undertaken a publicly administered long-term care program. And we'd like to explore that, particularly as other states are considering similar legislation, and obviously the COVID pandemic exposed even further challenges in this area. So those are our two topics. We've submitted these in writing and be happy to work further on that. Thank you.
Thank you, Teresa, and I appreciate your submission there, and we'll go from there on those. I also have before you a consideration of a resolution in honor of Kentucky Senator Tom Buford. If you knew Tom, he was he came to a lot of NCOIL meetings and he passed away. And I think I'd like to just basically, it's a recommendation, a resolution honoring Senator Tom Buford from Kentucky. It's sponsored by myself and then a delegation of Kentucky Representative Jared Carpenter, Representative Joe Fisher, Representative Deanna Frazier, Senator Rick Gridler, Representative Jim Gooch, Representative Derek Lewis, Representative Chad McCoy, Representative Bart Rowland, and Representative Steve Rudy. No. So Bart or Joe, I was going to say, do you guys want to make any comments or?
No, I appreciate the executive committee considering this resolution in honor of Tom. Tom served over 30 years in the Kentucky State Senate, and he was my co-chair for a period of time, and he chaired the Senate Banking and Insurance Committee. And I guess I really best got to know Tom, though, during my time here at NCOIL and at the dinners that we would have and the lunches and the free time we'd have to hang out together. He extremely smart man, very witty. You could tell by the way he was able to roll the humor just right off his tongue. It really takes an intelligent person to do that. We're definitely going to miss him, not only as a legislator, but as a friend. And I appreciate the executive committee doing this. And Joe and I will be sure that it's communicated to his family and his friends. And Joe?
Thank you, NCOIL, for this resolution. As you can see by the resolution, Tom was a very productive legislator over the years. I've known Tom in my 23 years in the legislature. He became chair of the Senate Banking and Insurance Committee back in 2000 when his Republican Party took over. But even before that, he was able to cross party lines and pass a lot of legislation. And he was just a delightful person to be around and to work with. So thank you very much.
Thank you, guys. I appreciate that. And I know Tom will miss here at NCOIL as well. So I would like for a motion. Would one of you like to make a motion to that and the other second it? Second. And then all in favor, we'll say aye.
Aye.
Thank you. That is all I have on my calendar. Tom, is there anything else?
No, nothing for me, Mr. Chairman.
Will, anything else? Anything else for the sake of the order? I do want to thank my fellow officers. Sometimes I get to be in the spotlight because the arrows are pointed at me, but I do thank Kevin and Joe for being here and for their help. And for Ken, you've been a faithful trooper on the Zoom, and we're looking forward to seeing you in person in Scottsdale. So with that, I would entertain a motion to adjourn. Is there a second?
Mr. President, second.
We'll see everybody in Scottsdale.